Profit's Budget Investor Guide. I'm Tamanna Inamdar, and with me, of course, is Agam Vakil. Agam, exciting morning on a Saturday, a day before Republic Day, and which is why we're all dressed in Indian. But it's also very exciting because we are bringing veterans of the industry right to you to hear from them 5 days ahead of the budget, and a time when the Indian markets are trying to find its feet. We also have some very special guests in our studio to participate.
So this is our first conclave at this point in time, and what's going to be really interesting is that not only will we have questions from us, but we will also have questions from the audiences, and a large part of the audience here comprises of students. And of course, we will also have a part of a research team who will contribute in terms of all the curiosities you all have with respect to the markets currently, and have them addressed by market veterans.
And who are those market veterans? We have with us in studio Ramesh Damani. We have Nilesh Shah, founder Envision Capital. Welcome to both of you, and thank you so much for joining our investor guide at a time I think investors really need guidance.
Thank you, Tamanna. Thank you, Agam, and happy Republic Day to all of you also.
Yeah, happy Republic Day to you as well, Ramesh Damani and Nilesh. But we also have with us on the show today Prashant Khemka, founder of White Oak Capital, who is joining in remotely. Of course, like Agam said, students of NMIMS College will also be there in Mumbai. They have a lot of questions to ask our guests and our very own research analyst. There's Prashant. Prashant, very good morning to you. And thank you so much for joining in.
Good morning to you and Agam. Thanks for having me here. Good morning, Rameshi and Nilesh.
All right. So let's get set. Let's get started and get the ball rolling. And of course, this is live. If you want to call in, contribute, give us questions that you want to post to any of our veteran guests here today, please do that on any of our social handles, and we will make sure that that is conveyed. But let me start by setting the stage with you, Mr. Damani. And once again, so great to have you here at a time when things are uncertain for a whole host of investors who are maybe newer to the ups and downs of the market. And just setting the context, you have budget in a few days. We're in the middle of corporate results, which have not been the greatest. Markets have been consolidating, and no one's quite sure what's happening.
Yeah, Tamanna, thank you again for having me. You know, world represents, after a 4 or 5 year almost unbridled bull run that took the index from 20,000 to 80,000 plus, we're going through a correction, which is normal beast of the market. The volatility is normal beast of the market. But and as you pointed out earlier in your preamble, we are having the budgetary session in a few days' time. And while it's very important what happens in Delhi, what I find equally fascinating this time is what's happening in DC, Washington, DC. I think President Trump is setting the economic agenda for the world. And the world had, there's a very famous book by Francis Fukuyama called The End of History, where he talked about after the Berlin Wall fell, we'll all move to liberal economies, market-oriented economies. And the world progressed dramatically in the next 30 years after the Cold War, or the next 40 years after the Cold War. That, I'm afraid, is about to change. I think President Trump now is in power, has already signaled that. His idea of making America great again is to make America greater again by annexing Greenland and Panama, for example. He's encouraging, for the first time, oligarchs to come to power today. I mean, Elon Musk spent $400 million in his re-election campaign. It's not out of the goodness of his heart. He wants some favors back. America's system of meritocracy, not of oligarchy, that will happen. The multilateral institutions that America created, the world that America created, through WHO, NATO, are probably likely to be disbanded over the next few years. He's already pulled out of climate agreements, WHO. So we may not like it, or we may like it, but America continues to be the centerpiece of the economic world. Its market, its economy, its size means that we have to pay attention to it. So I think we should also not only pay attention to what's happening in Delhi, which of course is important, but also what's happening to Washington, DC. But my feeling there is that instead of making a left turn or U-turn, left turn or right turn, they're making a U-turn there.
In Washington, D.C.? In
Washington, D.C., yeah.
Wow, wow.
Right, Mr. Damani, I'm going to talk about India, and I want to revisit this question that I had one back in Diwali when I'd spoken to you about that. About 10 to 15 years of a solid bull run in India. Where are we at this point in time? And I know that we're in a slightly different stage now as compared to where we were in Diwali. But if you just zoom out and look at things and how things are, where are we from an Indian perspective?
Yeah, thanks, Agam. That's the contradiction in my position. While I'm extremely nervous about the macro developments going on, I'm not particularly bearish on the Indian economy, and I'll tell you why. Market's corrected, it's in a bad spot, but I think it's just part of the historical correction that's taking place.
Yeah.
A 4-year run, if you correct, I can't blame the market for correcting because markets are known to do that. And the reason I feel more optimistic than pessimistic is when I don't look at the last 10 days or so, but look at the last 30 days when the market has been well within the correction. I run a very diversified portfolio, so I have lots of stocks in my portfolio. A lot of them have been making new highs, lifetime highs, which is extremely rare to do in a bearish phase of the market.
Right.
It just means that the market is actually latching onto good ideas. So a lot of stocks, even yesterday's carnage, made a lifetime high for me in the market. And secondly, when I go and visit my companies, when I go and actually put my feet on the ground and talk to them, there's a lot of exciting capital work going on, a lot of excitement, sales forecasts going on, a lot of excitement going on there. So while the earnings may have slowed down for a few quarters, I don't think it's a permanent slowdown. I don't think it heralds the beginning of a bearish phase in the market. So, and particularly the stocks that have led this bull market higher for the last few years, the public sector stocks, I think there's some very exciting stories because the government is, and that will be proven in the budget if they increase the capex for defense and rails. And there'll be a whole new leg to some of these stocks. I think the better corporate governance is a story that is still being written about those public sector stocks. Yeah. So, nutshell, while I'm extremely concerned with the direction America is moving in and where it will take the rest of the world, I think India perhaps may manage to escape because the domestic economy, it benefits from China plus one philosophy. So I think we might dodge a bullet and be okay.
Sure.
Nilesh, let me come to you on that point as well. And just first setting the context that we're here ahead of the budget, that capex push, which Mr. Damani just spoke about, that becomes very, very important for the market because usually, we ask you guys, what do you think? How important is the budget? And you say, no, not really. Budget is one day event. This time it's a little more important. Or maybe a little more hopes.
No, absolutely. I mean, one of the pillars or one of the tailwinds that the market has had in a post-COVID era is the significant step up in spending by the government, especially on infrastructure. That's essentially helped India to kind of, sustain those relatively high growth rates. And that's very powerful. It's very impactful because we're not talking of a $4 trillion economy and 3 to 4% of that going into infrastructure. That's a lot of money, a lot of capital, a lot of investment, and the multiplier effect of that on a lot of industries around that, be it cement, steel, or any of the other, or in terms of employment, in terms of job creation, in terms of credit growth, it has a huge, massive multiplier effect. And that's one of the areas which has been the cornerstone of the Modi administration, but I clearly think that even in this budget, it becomes even more imperative because you're seeing signs of sluggishness in terms of private spending, private capex, the impact on the middle class, and the middle class probably taking a few steps back. So I think it's best to assume that consumption-related spending, especially the basic core consumption-related spending, will go through a grind, will go through a bit of a slowdown, and therefore it will still be on the part of the government to significantly step up investments on the infrastructure side. So I clearly believe that, and that's something which is very differentiated. You really don't depend on the world for that. You have a lot of room to do it. It's totally internal to you. Maybe with a bit of push, and I know that's obviously gone totally off the table, which is privatization, disinvestment. Yeah. If capital raising is a constraint, probably is to basically take out money from maybe wherever you can make money and put it into areas which can have a multiplier effect. So it's better use of capital. So I clearly believe that if there's one thing that I would want to look forward to in this budget, it is essentially the whole infrastructure sector. There have been many projects in the pipeline. For example, there's so much which has happened on railways, right? And in probably a couple of years, we would have our first high-speed rail network going, the bullet train project going between Mumbai and Ahmedabad. And the government is trying to kind of try and indigenize that and try and make those things in India. It serves multiple purposes. I mean, it's building world-class infrastructure. It contributes to ease of living. It leads to indigenization. It leads to local job creation. So while we're all currently thinking about making America great, I mean, how about making India greater? And I clearly believe infrastructure spend is a fantastic silver bullet by which we can achieve that. Truly Atmanirbharta.
I think the only question is, make America great is fine, but not at the cost of, other nations in the world. If it's going to come to tariffs, etc., and where does India stand? Perhaps that's...
See, Tamanna, that's the problem with Trump. Trump has a zero-sum view of the world.
Yeah.
Either you win or you lose. Either you dominate or be dominated. He doesn't understand the world that America created post-World War II and more so after the Cold War. Where, can you imagine an America under Trump supporting Japan and Germany were beaten in World War II? Or can you imagine the kind of exports that allowed Taiwan, Singapore, Korea to become a part of the developed economy of the world? It won't happen. He thinks a very reductive view of the US presence. And I always have this famous saying by Rudyard Kipling, what does he know of America who only America knows? To paraphrase him, well, Trump clearly knows the pulse of the American electorate. He doesn't understand, and his particular electorate doesn't understand America's role in the world, how they shape the world, and how, by spreading prosperity to even countries like Japan and Germany, they spread prosperity to themselves, improved the standard of living, made a secure world, supported multilateral institutions. America's role in the world is historical, and I think Trump doesn't see that. He sees it in a very more narrower sense. And I think that will be the biggest change in the next 3-4 years that we'll have to grapple with.
Right. Prashant, welcome to the show. My question then would be about markets and where they stand at this point. And while we see valuations, and I'm talking about index valuations, and I know this is a very crude way of perhaps valuing markets, but most index valuations are at their 5-year averages. So something like the Nifty, the mid-cap index, and the small-cap index are at their 5-year averages, which means possibly the froth is out, but overvaluation is still in the picture at this point in time. What is your view on this aspect?
Certainly. So I think, as you pointed out, we are at about average levels compared to last 10 years. So I don't see any worry, or I don't think there are worries I see amongst investors, but I don't think, I don't feel worried about the valuations at this time. And particularly, I do think, and somewhat, with all due respect, and I agree with Rameshji that the global uncertainty has increased. But I think a somewhat different perspective here, in that I think re-election of Trump, whether we like him or not at personal level or not, I think is positive for certainly US markets, US economy, US corporate earnings, but also positive overall for many other equity markets. US is as was just mentioned earlier, the largest economy in the world, 70% of global equity markets. If we were to agree that Trump, who measures his success with stock market as the barometer and is pro-economy, pro-growth, pro-corporate earnings, that's going to be positive for US, but that US being so large is going to have a gravitational pull on the rest of the world as well. And India, obviously not uniformly across the world, there would be certain countries going by his first term and how he, what actions he took in the first term. It may be negative for certain markets like China, certain economies in the neighborhood of America. But for India, it was positive last time. And I am of the view it would be positive this time as well. So if the largest economy in the world and the 5th largest economy in the world, it is positive. I think net, and maybe it is my inherent optimistic self, but I do think the global backdrop is going to be firm over the next 4 years. And the Indian backdrop as well, I see continues to remain firm over the coming several years. So given where the valuations are today, it is a very good time to stay invested.
Ramesh sir wants to come in on this point.
Prashant, let me explain to you how transactional I find Trump. For example, he first banned TikTok. Now he's extended TikTok's. TikTok's almost a $1 trillion company, perhaps by valuation out there. At the same time, the same president is banning US steel being bought by Nippon Steel from Japan. Japan is an ally now, 50 years in America. It is no national security threat. It's a $15 billion company. It has no employment prospects greater that are affected. In fact, even the US labor wants the US Steel, Nippon Steel merger to go ahead. And yet Trump is opposing that.
But didn't Biden do that first?
Biden do that, but let's leave Biden out. We're talking about the Trump presidency. I'm not trying to see who's better, Trump or Biden. I'm trying to explain the Trump presidency to you. So it is not free markets. Where is he free markets? In the free market, Trump would have allowed his transactional approach, his oligarchian approach. If you contribute to his campaign, if you made him feel good about that, he'll probably support your Bitcoin, he'll support your TikTok. If you oppose him, he will oppose it. That is not the way to run a rules-based system. The world prospered under a rules-based system. And I think that is a good example. It's a $15 billion acquisition. It's irrelevant in the scheme of things. $15 billion for an economy that controls 3/4 of the world economy is irrelevant. And yet he's opposing that. Why? And yet he's not opposing TikTok, which poses an obvious security threat, unanimously passed by Congress, unanimously passed by the Senate to ban TikTok. And yet he's delayed it. Why? Because someone contributed his money. So, you know, what we are having is a transfer from a merit-based, rule-based, democratic system to oligarchy and state-sponsored capitalism in China. And that can't be good.
Any response, Prashant or Nilesh, if you all want to come in on that? Prashant, okay. Yeah.
No, I think what specific examples Rameshji has cited, certainly true. But in any democracy, not all the decisions are taken on the basis of sound economics, even in India. In certain specific instances, like US Steel that was cited, it is or TikTok, you know, it may be that political considerations overtake economic considerations. But if you look at in the entirety, and again, going by the first term of Trump, and I hope this term is better, on the entirety, I think the policies are good for America from an economic perspective. I'm strictly talking about economics here. And yes, I'm very worried about dismantling of global institutions or pulling away from global institutions like WHO or NATO, which are very powerfully, not as powerful as they should be, but to the extent they're much needed in the global order. But I think here too, there's a lot more rhetoric than real actions. He would take some actions as well, as he has taken, pulling out of climate group and others. But there'll be a lot more rhetoric than actions. And the rhetoric is to force other nations like the European nations to contribute to a greater extent. And it's a negotiating tactic. He's ultimately not going to follow up on everything he's saying, and he doesn't intend to.
Nilesh, you've been listening very carefully to, and this is a great debate because, you know, most of the market or a lot of global equity traders and watchers think Trump is going to end the wars. He's going to fix a lot of issues. And there are, of course, many, many people who have the view that what he's doing is not going to be good to the world. And I know we started this as a budget conversation, Indian market conversation, but hey, this is the biggest factor right now. Do you want to jump in?
Well, the good news at least is that we know what's coming.
Do we?
Okay.
Do we?
In the sense that at least we are all we beginning to talk about it. We are already kind of saying what are the ramifications, the implications. We know that there could be more barriers to trade, there could be more barriers to commerce, there could be more barriers to flow of capital. That's like kind of pretty much, I would probably say a kind of a pessimistic or a doomsday scenario, in the sense that maybe the global trade may not be as easy as what it has been over these years. A lot of areas around globalization might just be unwound. Now that's essentially a starting point. I think the message is very loud and clear that we will have to be proactive. Yes, like what Prashant said, that every government has its own compulsions in terms of politics or domestic compulsions, but we will have to essentially now up the ante further. What worked for a $2 trillion economy may not work for a $4 trillion economy. If we have to go from $4 trillion to $8 trillion or $10 trillion, a lot of things will have to be fast forwarded. And if we don't do this, we will probably lose our relative competitiveness. Because I think for India to kind of sustain high growth rates, there is no choice but to essentially be hugely focused on manufacturing. Services, yes, we probably occupy our place in the Hall of Fame. But on the manufacturing side, we've got a long way to go. And in manufacturing, unless we focus on the world and the exports, we will not be able to build scale. Most countries in Asia have done it that way, and I don't think today, at the juncture at which we are at, we have a choice of services or goods. We will have to do everything that it takes for us to really get to that 7 to 8% growth rate and sustain those growth rates. And for that, a lot will need to be done. And the good news is that we know that we probably have headwinds coming in. If, like what Ramesh said, that if something could happen with, say, Japan, which has been a 50-year-old ally, then I think the rest, how much do they matter? And if that's the message which is loud and clear, we will have to do a lot of things to ensure that India becomes competitive, and competitive in the global context. And therefore, I believe that therefore it's good news that we know that what's probably going to be in store for the next few years.
Okay, well, I think this is a good time to get some questions in from our audiences. So I guess if we do have volunteers at this point in time, maybe we can start picking questions up. So do we have anyone who wants to, take a question up? Please go ahead. Do you have the mic with you, sir?
Yeah, yes.
Yes.
So first of all, good morning to all the panelists. So my question will be that...
Why don't you start by introducing yourself?
Yeah. So myself, Naman Vaishist, I am currently pursuing MBA Finance from SBM and MIMS Mumbai. So my question will be that with the government allocating 10,000 crore budget for India's AI mission, so how you think that government will leverage AI to improve efficiency or transparency in government and businesses systems, while also supporting the MSMEs, which creates a large chunk of employment for the country?
Who is your question for?
To both the panelists who can answer.
Okay.
We'll get the harder questions to him. Nilesh, you go.
No, honestly, in fact, 2024 was all totally driven by AI. The discussion, Max, if this year the start is with Trump and tariffs, last year it was all about AI, chat GPT and those kind of things. So clearly, I think India has been really successful and at the forefront of adopting technology and making it work. One of the most powerful things which has been going for India has been digitization. Way back, right from Aadhaar, the digital identity, all which has then really helped a lot of companies to create platforms and helped the government to do direct benefit transfers, to deliver subsidies, to launch welfare programs, and ensure that there are the least leakages. AI is going to be now the next new frontier. How exactly that will help is hard to at this stage fathom or envisage, but it's quite sure that the impact of AI is going to be manifold. It's definitely going to be a growth booster for India. It's definitely going to improve productivity. It's definitely going to improve efficiency. That I don't think there's any debate. But what could be the timelines for that? What could be the milestones that? Or how do you measure the impact of all of that? Or what could be the specific measures is hard to determine. I also think that 10,000 crores is a starting point. Today, I think 10,000 crores is roughly slightly about over $1 billion. $1 billion for a $4 trillion economy, I think is just is small. I don't think capital is the constraint. One should not read too much into that number of 10,000 crores. More importantly is that AI is going to be transformative. I think the challenge we have in India is diversity. And if there's something which can pretty much neutralize that diversity and continue to help everybody get into the mainstream, I think AI will play a huge role. And this role will not just be for us as individuals or us as citizens. It's going to be for the government, it's going to be for businesses, it's going to be for enterprises. See, one of the reasons why our small and medium enterprises have done so well over the last few years is because of access to technology. With that access to technology, they've been able to access this one big India market and reach out to 1 billion plus consumers in pretty much the same breadth. Unlike 10 years ago where they had to create a distribution channel on a pan-India basis. Therefore, I think the impact of AI is going to be huge, it's going to be profound, but really hard to say what exactly, how things will go forward.
Nilesh, I have a follow-up on that one. There is a feeling on the street that when it comes to Indian technology and Indian technology companies, the relatively larger ones, one, they don't have a vision in place. There is a feeling that they don't have the right strategies to implement whatever little vision they do have with the kind of, with the kind of ideas perhaps the world needs. It does seem like at this point in time, they're just struggling to stay afloat. Is this a consequence of the current circumstances, or is there a genuine problem with the vision of Indian tech companies at this point in time?
No, it's a different path that they embarked upon.
Right.
And that was the path of technology implementation versus technology creation. They have not been the Brahmas, they have been more the Vishnus.
Sure.
Which is that how do I kind of keep delivering technology-oriented solutions to big companies worldwide, and that's the path they have chosen. Right. That's more a linear path. Traditionally has been driven more by headcount.
Right.
And it's hard for them now to change course quite dramatically. And even if they do, it's not going to be very meaningful for them.
Sure.
So the big top 4 or 5 technology companies, obviously these are good companies. Yeah. They're very high on governance. They're very high in terms of their return on equity. They all deliver consistently about 25% return on equity, which is exemplary. But the big challenge is growth, that when you become a multi-billion-dollar company, you're hiring few 100,000 people.
Yeah.
And then for you to suddenly change course and say, okay, now from a preserver or an implementer, I'm going to be a creator. That's the challenge which they face. So I don't think one should read too much into it that they lack the vision or they lack the strategy. It's just that that's how they evolved for the last quarter of a century.
I think the concern is, are they behind the curve?
No, I don't think so, because they have never been creators of technology. They have been implementers of technology. So it's fine if somebody else has created an AI. That's perfectly fine. If there's somebody else who's created an LLM, who has spent billions of dollars for years trying to do that, that's perfectly fine. But the bigger opportunity is always going to be around who's going to go and take that AI to different governments across the world, to different companies around the world. And that's really where the Indian IT services company will continue to play a role. Whether you start off from the days of the Y2K moment to essentially the whole adoption of internet or the advent of internet, and then digitization, it's always been the Indian IT services companies on whom the shoulders this whole opportunity has fallen upon.
Absolutely.
And they have gone ahead and exactly done that.
Perhaps that's what we need to diversify now. All right, one question. Who else is coming? Okay, I'm going to come to our very own Mahima.
Yeah. So hi, Mahima this side. I track the consumption space. Since quite some time now, we're seeing that there was a time when rural was not picking up. Now the urban consumption is not picking up. And when I spoke to managements, they said that if there's more money in the hands of a common man, the consumption will eventually pick up. But I think, in my opinion, it's a structural a shift that the consumption space is facing overall. But I also want to know, with respect to your views as to how do you think the government can, bring the overall consumption up? Is it the tax change, or do you think that there's something else that the government needs to, kind of intervene in? This question is for Mr. Dawani.
Yeah.
It's an easier one.
Thank you. Not necessarily, but thank you. I'll take it. I think that's what they're hoping for in the budget, that they will reduce the income tax rates in order to increase consumption. I think what the government is getting crowded out. What they're doing, Mahima, what I realize is that to win elections, they're giving freebies to a lot of middle class. One of the pink papers this morning had an analysis of what happened in Himachal Pradesh. This is one of the richest states in India. And the below poverty line, according to their definition, is 75% of the population. You're giving freebies to 75% of the population. Why give it to 8% when you give it to 75%? So a lot of the money that would have gone in for boosting consumption is perhaps going as a stimulus shot to the lower class. And as you say, that is spending. But, these things are just, a matter of budget priorities that the government does. Given India's population, scale, size, I think consumption will have to revive in order to be good. But if you're looking from how do you play India over the next 2-3 years, some of the consumption stocks have rightly got a whacking because they're really high growth stocks without growth in there. But you focus on the domestic economy, companies that will benefit from government spending rather than, for infrastructure, for defense, for railways, for, so many assorted priorities that the government has in the budget. You play those stocks. You don't always have to play consumption in order to win this game, I feel.
Okay. Any more questions for Mr. Khemka?
I got a busy crowd today.
I know. I think we got them to make our jobs easier, but it's great to have all of these
please
voices.
Go on. Yes, please go on, yes.
Hi, my name is Juisha Gandhi. I have a question for Prashant sir and Mr. Damani sir. So, ideally, what you all said that
In your mic.
Yeah, so the policies that Trump might get could restrict the flow of capital in India or could leverage it more. So what do you think, should the government prioritize spending more and making businesses, finances more accessible using Indian capital markets? What are some measures they could take for that?
Okay, Prashant sir, you'd like to fill that first?
Certainly. So first of all, look, everything that I said about Trump and impact on India, we have to keep in mind that it is marginal influence. India's destiny, India's growth in the short term or the longer term is in hands of Indians. And, we are doing fine over there. So we are talking about all marginal stuff when it comes to Trump and its impact on India. As it comes to capital flows, that applies to capital flows as well. India needs to continue along its path of making it easier to do business in India. And if it does so, capital, and when I say capital, I mean both, flows into the equity markets, but more importantly, flows into the real economy here. The capital market flows are also very important, but in real economy, if we continue to move further on making it easier to do business here, and we have we've come a long way from some 142nd, if we were to use that as a measure in terms of ease of doing business, to where it was last reported in 2020 at about 50, at 62 or something. But even if we are 40 now, there are like 39, 40. If we are 40, there are so many other countries who are ahead of us in terms of ease of doing business. We have to continue to make it. In cricket, we can't tolerate being second, right? And this is more important to our quality of life. We have to continue to move towards being number one, if not number one. Like every company management talks about, we want to be number 1, 2, or 3 in their business, because that's where the profit pool lies. That's where the fruits are enjoyed. They have to continue to move along that line. And if we continue to do so, capital would come, regardless of what's happening in any other country, including in the US. Particularly as it relates to capital flows, I think in the very initial few months, there's a massive suction of capital into the US. We see it amongst our client base, amongst foreign investors that we deal with. They're all looking for ways, direct, indirect, to increase their exposure to the US. And that US being so large, 70% or so of the global equity market, the money is being sucked out of almost every other global equity market at this point in time. Once that stabilizes and normalizes, I think India does tend to benefit from flows as it did, especially on the foreign direct investment side, but also in capital market flows, as the anti-China rhetoric, if it does translate into actions like it did last time, India would be a relative beneficiary of flows coming out of some of the emerging markets, including China.
Ramesh sir?
Yeah, Ton, I'll share an interesting anecdote with you, how important I feel America is. You all were not born when John Kenneth Galbraith became US ambassador to India. He's a very famous economist. He could be any position he wanted in the Kennedy administration, and he chose to be ambassador to India. And in one of his statements, he said that the finance minister of every emerging market should have his house in Washington, D.C., and not necessarily in the state's capital, because interest rates that are set in America, liquidity flows that emerge from America, are far more important to that country than including their own country's budgetary policy. So America is extremely important. So we need to encourage and, in fact, propagate FDI and FPI flows from America to India. We cannot prosper as a country. We don't have the capital to grow and to become a prosperous Viksit Bharat by 2047 without capital coming in from America. So we have to be hospitable to the capital, we have to encourage that capital, and we have to make the world according to them. My feeling with Trump is that, he actually doesn't want to do that. He's a very transactional person. He feels that there's something called the mercantilist policy, which is as opposed to the globalization policy we had, where you try to beg your neighbor, you say, I will sell to you, but I won't take back from you. And that is a policy we tried in India in the 70s and 80s. The so-called self-sufficiency policy, no one worried about growing the cake. We always were worried about cutting the cake. I think it's astonishing to me that America is going back to that philosophy. Here's a country that, you know, made themselves the envy of the world, and they're going back to a very reductionist philosophy.
I just want to ask Nilesh one point on it in the context of what Mr. Damani said, that how important flows of capital from America are into India, and broaden it to what we've been seeing with FPI flows, one-way street for the last several months out of Indian equity. What is the case for that set of capital to return? Why and when would foreign flows return into Indian capital markets?
So, well, if we look at it and what Prashant basically said, that, you know, most of the global investors, foreign investors, are looking at basically putting more money to work in the United States, you know, versus rest of the world. Currently, it's not an India-specific problem. It's more essentially a global issue where investors are saying, how do we put more into the United States, because the whole emerging market pack is still very small, and maybe India's share could be maybe 1 to 2%. So do you really currently want to bother about 1 or 2%, or do you want to really more worried about, are you 60, 70, 80% invest in the United States? That's something which moves the needle more for them versus an allocation. But otherwise, the simple point is, I think maybe if in the current sell-off, if the valuations become more attractive, or if we essentially have some booster dose in terms of policy changes, economic reforms, maybe tax rationalization, if those are some of the things which essentially get rolled out, then maybe that could act as a magnet for those flows to reverse and start to kind of look at India as a true global emerging market, which is truly growing at significantly higher pace, is becoming a more attractive destination for investments, and will deliver the alpha that they are seeking out for. I think it's a combination of both of these things which will be required.
Okay, well, I guess we can have another member of our own research team ask a question. Anushi?
Hi, I'm Anush. I'm part of the research team here. My question is to you, Mr. Shah. So in the earlier part of the conversation, you emphasized on the importance of infrastructure in the budget. So we have three big pockets, that is defense, railways, and infrastructure in focus. What are some of the key expectations or some of the surprise announcements that we can look forward to in the upcoming budget? That is the part one of my question. And as an investor point of view, when I'm looking at these three big pockets, in the recent times, we've seen a lot of correction here. This is based on the valuation picture that is given, but the growth opportunity, the tailwinds that we see is immense on this field. So as an investor perspective, if I want to look at these three pockets as a starting point, is this the correct time to view these three sectors if we see?
Well, all three sectors clearly have the highest potential, undoubtedly. And impact, not just in terms of what they do for their individual sector, but they basically the impact that they have in terms of the multiplier effect. And this whole drive about indigenization, job creation, I think the impact is quite phenomenal. What can be done? I clearly believe that yes, of course, you could have a lot of policy initiatives, new programs, a lot of programs which probably were being thought about to be introduced maybe 3 years from now. Maybe can you fast forward them? I gave the example, or I referred to essentially the bullet train project, the Bombay-Ahmedabad one, which probably will kind of kick off, or the trains will actually start plying maybe 2 years from now or 3 years from now. And then maybe we think about rolling out similar projects on a pan-India basis. Can we start doing that now? That obviously requires execution capability as well, apart from requiring a lot of capital to do that. I think at this point of time, it has to be more allocation. We probably will need to start to allocate, maybe not just, we've gone up from maybe 1.5% of GDP 10 years ago to about 3% of the GDP now. So that's a 2x growth in terms of percentage allocation, and in this period the economy itself has probably kind of doubled. So you've seen probably a 4 to 5x growth in allocation in absolute terms. Maybe that 3% needs to kind of move up to 5%. Obviously, there will be budgetary constraints, but it will have to be taken up as a national priority, as a strategic priority, rather than a simple budgetary allocation. So that's what I would want to kind of look forward to.
Should we quickly take one more? Now, we can't take one more research analyst. Let's not be partial to our internal team. Okay, I will take the gentleman right at the back. You have a mic?
Yeah. Yes.
Tell us your name first.
Yeah. So good morning, everyone. I'm Harish Sarda. So my question is to Ramesh sir. Actually, if we see the Income Tax Act, so can we see expect any changes in the income tax rates or in the capital gain rates, because that can be an impact basically on the capital markets, what I look on. So what are your views on it?
Yeah, Harish, thanks. Typically when I was your age and we'd go to the ring during the budget days, there was electricity through the environment because the changes in direct and indirect taxes will affect capital markets. But of course, with GST now that has been subsumed. So the only thing that remains is direct taxes that can happen. So a few years back, maybe last budget session, they changed the capital gains rate. So I don't think they're going to change that another time. They can't keep changing that because that sends a bad policy signal in terms of continuity. So what will perhaps change is the income tax slabs. I think they'll be a bit more better for the middle class. So I think you'll see some changes in direct tax rates. But other than that, I don't expect to see any major changes. And as I think we always say on television, that the budget is starting to become a 1 or 2 day event, and after that market moves on. So I think you would expect to see some changes, but not dramatic changes.
No, but when you say that you used to go to the ring, I don't think that they will get that
They know
reference.
what the ring is, yeah.
So you must, for our viewers, explain what you mean, because I think it'll be very interesting for them to understand.
Yeah, I mean, I think Nilesh talked about the digitization of India. And before digitization, we had an analog system where we met in a physical ring where people bought and sold shares across each other rather than on a computer screen. And your accounts seamlessly transferred to a demat account. You used to get physical shares, you had to get them transferred. It took 6 months. It was a hugely onerous process. And to give you a perspective, on a busy day in 1990, on a busy day in the Bombay Stock Exchange, you did probably 400 crores worth of trade. You can do, I think, 4 lakh crores now. It's become so seamless. So we've come an extraordinary journey. I mean, the institutions in India has built in terms of capacity, capability in the stock market are actually world class. We've built that. So we stopped the ring, moved to a completely electronic, completely dematerialized system, and thank God you don't have to go back to that system. It was actually one of the most painful, paper-driven systems that we've been a part of. So I think this digitization drive is another theme that, as you all grow up and prosper, there'll be lots of opportunities to skin the cat in that theme itself, because India is now a world leader in digitization technologies. So a lot of the emerging markets, a lot of emerged markets will want to copy India's so-called India stack. So I think if you were asking me which sectors would young people look upon to,
yes,
I would say digitization is a theme that will play out over the next 10, 20 years in India.
So, but then those are, I would say platform companies already bought into, and valuations are skyrocketing.
There are many ways to skin a cat, Tamanna. You'll find out, so you will find opportunities. I think that's the job of a good analyst, to look, beneath the obvious plays and see maybe power companies, cable companies, software companies that will benefit from digitization.
Yes, yes.
Just on that, continuing on that, in fact, I just read about a couple of days back one of the media reports which says that the Ministry of Electronics and Information Technology has recently released a report. I have not seen the report, but I've just read this as a news item. It basically says, this report says that by 2030, India's digital economy will grow at twice the rate of the India's real economy. And that the share of digital economy in the GDP will become a fifth of India's GDP and will be bigger than manufacturing or agriculture on a standalone basis.
Stunning.
It is.
Now, I don't know whether this report is, I have not seen the report, but this is it. This itself, I think the administration and the government itself is giving you investment ideas on a platter that you know where to look out for. So clearly one area is going to be essentially the government spending in areas like railways and defense. That's really where a lot of growth is going to come about. But here is the digital economy. I think, like the way Ramesh said, that we have to figure out what will really work for us. Obviously, the basic tenets of investing around governance, cash flows, capital efficiency, these are there. But these are the big opportunities.
Prashant, I just want to ask you, because we're talking about taking a cue from what policy shows us as investment ideas. Is there a budget trade right now at a time when there is such, I would say, careful kind of mood in the markets, and then this is the next one event that we're seeing around the corner?
Very short answer on that, Tamana. We are just not geared, neither myself nor our team, to uh, think about, you know, such opportunities in the very short term. And the reason is we are geared this way is because there are, in my view, no such opportunities in such a short time period that you can. A budget is a very tightly held secret. Nobody knows what comes out till it comes out, is my view. Unless if you have some insights, then maybe there can be some short-term trade that can be created out of it, but it's not our style or not our view that money can be made or trades can be built around an event like budget. You'll know it when it comes out.
Completely understood. But you know, even from a long-term perspective, which is what we're talking about. I mean, it's a coincidence, but it's an interesting one that Feb 1st is the day that President Trump has announced for levying tariffs on Mexico and Canada of 20%. I don't know if he will do it on that day, but it's the day of our union budget. Would you be looking at whether we're fighting fit? Because if they're levying tariffs on Mexico and Canada, are we going to increase our duties, reduce our duties? What are we going to do?
No, that's a very good point. And it's, again, not just about increasing or decreasing duties. To be fighting fit, we have to continuously be at it. Remember, and I keep harping on ease of doing business and again, but that's the real thing. I think we compare ourselves to 10, 20, 30 years ago, and we've come a long way, but it's a competitive world. It's like a sport. It doesn't matter how many runs you score in cricket. Yeah, it matters whether you're scoring more than your opposing team, your opponent team. And here in this game, you have a large number of countries who are all trying to grow faster and attract foreign enterprises, foreign investors. Yeah, and they're getting better each year as well. So we have to keep getting better at this each passing day, each passing year. And budget, to me, every time I look for what the government thinking is along these lines. Are they making it easier to do business in India for not just foreigners, but for Indian corporates? Yeah. A very simple example, if I would give, one particular thing that I look for in every budget is whether they would make it possible for fund managers sitting in Singapore, Hong Kong, London, and all to be based in India and do the business. Yeah, it's 10 years ago, Honorable Finance Minister at the time, Mr. Jaitley, he announced, and in his words, he said something to the effect that to attract fund managers from around the world back to India, he's announcing this law. And it's yet not operationally effective because of all the nuances of the law that make it impractical. So that's a perfect example, very close to my heart and to our industry, where this entire segment of the industry is not possible to conduct business in India. And it is just one example, and there are hundreds, if not thousands, of such examples. We have to fix these, and these are relatively low-hanging fruit, in my view. And those are what I look for in the budget, whether it's making it easier to create jobs in India. Job creation is a imperative in India. We had a question earlier about consumption, why it is weak. And, freebies and all are okay. They are also necessary. I'm not saying they're not, but the longer term solution is massive job creation in India. It is only possible by having policies that would make it easier to create jobs in India.
Nilesh, you want to come in on that, specifically from this budget at this time? What do we need to see in terms of India remaining competitive and moving ahead? And may I request you to look at that?
So, Taman, I think the real thing which is really required is around the GST. Okay, I think as far as the budget is concerned, there's very little in terms of direct taxes. Yes, there could be simplification, rationalization, but which can just be done as an ongoing process. The real thing is to essentially address it through issues like GST, because we probably, from a GST perspective, are probably one of the highest taxed countries in the world. I mean, I don't know if there are too many countries around the world which have 18 and 28% tax rate. Okay, I probably think in most, at least in the developed world, it's probably high single digit, maybe 8% or 12%, number one. And number two is there are still so many components of the economy which are still outside the GST. Like I probably think the entire energy sector is outside the GST. The alcoholic beverages industry is outside the GST. Now, obviously, that requires a huge amount of consensus building because it's not a decision which can just be taken by the union government or the central government one shot. It requires bringing on board all the 30 states, building a consensus, and saying why this is imperative for India, for us to rationalize the entire GST regime. So that India becomes more competitive, Indian businesses become more competitive. I mean, I was reading somewhere that why are more people going to, say, Malaysia, Thailand, Dubai for a holiday versus India, and you go out there, the taxes are practically not there, or the taxes are maybe 4-5% versus that here, I don't know what the exact tax rate is, but it's probably 18% or 28%.
Yeah.
I was reading a report this morning that the recruitment industry, which provides manpower to a lot of sectors, services, I think I was reading they've requested that the GST rate should be 5% and not 18 or 28%. The moment you start paying 18 and 28%, that leaves very little in the hands of companies or businesses to give it back to their employees. So these are some of the things which are there, and maybe it's time to kind of really rethink the entire GST apparatus, the tax rates, that does it make sense to have 4 or 5 or 6 different tax rates, to have tax rates which are so high, if you want to essentially make Indian businesses competitive.
Okay, I think we'll take another question from our audience. I think if we can, should I ask?
Varsha, come on, Varsha's
She's been waiting for a while.
Thank you. I'm Varsha. I work here as a research analyst. Now, my question is to Mr. Prashant Khemka and also Mr. Damani. We have been hearing as a retail investor that, we should invest in large cap companies or mutual funds. But all the investors or experienced investors like you have made money investing through small cap. So your advice to retail investors, what one should do?
Excellent question.
I know. I thought I said no tough questions. Okay, I'll start. I'll take a stab at that first. First, thank you very much. And I'm very encouraged by the fact that more Indians and more young Indians opening demat accounts and entering the market. They're entering it perhaps the wrong way, in my view, through F&O trading. Please don't do that. That's my humble request to all of you. But look at it from my perspective. I came to India, I started my business in India when the index was 800. Today it's 80,000, okay? So we've had a great run. Is the run likely to continue? Yes, it's likely to continue. What should an individual investor do? There are a lot of people who don't have time for the stock market. If you're a lawyer, you're a real estate agent, you're a hairdresser, whatever, you don't have time. My advice is very simple. Invest in an index fund. Just put it in an index fund that tracks the Sensex or the Nifty or any mid-cap index that you like and invest in that. But if you're ambitious, you want to become rich, you want to, parlay compounding over the next 20, 30 years, you need to invest directly in stocks. Now, it's very hard to buy a large cap stocks that will become 10, 20x. It'll probably give you a market return. But if you want to really try and make benefit from the Indian economy, you need to, you're right, pick small cap and mid cap stocks that are small cap and mid cap today, but you see the potential of them becoming large cap stocks. And over time, that's a very rewarding journey. But that requires a full-time concentration. So you can't be done on a part-time basis, sitting on the weekend or listening to a friend's tip. You need to do some work, some thought process, some real strong effort to do that. So if you're willing to give that commitment in terms of time and resources, by all means look at the small cap, mid cap. But if you don't have the time, you're busy in your job, which is fine, and doing other things in life, my submission to you, the best way to do it is to perhaps buy an index tracking fund. So the index doubles in the next 5 years, you would have doubled your money. And that's not a bad place to be because equity returns are significantly higher than returns in fixed deposits, gold, real estate over a 20, 30-year period of time.
Prashant?
Pretty much the same thing. I think Ramesh put it very well. If you have the time, if you have the passion to research and invest, and you think of it as a hobby and a sport, and are willing to give that effort to this, then please, certainly do take up equity investing in small caps. It can be highly rewarding, and all of the people that you see on TV, on business news channels and NDTV Profit, who talk about and who made money in small cap stocks, including Ramesh ji here and Nilesh here, they have given tremendous amount of time. It's been their passion, right? And it takes a lot of hard work. They don't do it as a part-time activity over the weekend for an hour or two. If they were to do that and invest in small caps, they would have lost all their money and they would not be sitting here with us today. So that's what Ramesh is saying. If you are going to dedicate the time and effort, then try and pick those small caps that Ramesh said can have the potential to be the large cap and the big, huge winners. But if you don't have that time, then save yourself a lot of pain and just invest in either large caps, which are effectively, a piece of the index, but even better so, maybe pick index fund and save the risk of investing in individual large cap, which also can be risky if not managed properly.
How many people here are actively investing right now or looking at the markets? Let's get your hands up.
And how many of you are doing it in F&O only? I want to know that. Good. No one at least raises the hand. That's good.
F&O only was the question.
I mean, the kind of volumes you see in F&O just astonishes me.
Yeah. Okay. So, any more questions? Okay, quite a few. We'll come to you right here in the front.
Okay. Hello, sir. I am Ayushi from NMIMS Mumbai. So I want to bring into the picture inflation concept, and which has been a key issue in India. So my question to you is, how do you see inflation is going to impact the investors in the longer term?
Who's your question to, Ayushi?
Mr. Nilesh, I guess.
Okay. Well, I'm not an economist, so, but no, I mean, it definitely has elections, and inflation is a function of two things. One is, of course, demand, and we are a high demand, or demand is growing at a steady pace in India. Therefore, there's bound to be inflation because of that. But more importantly, it's always inflation can be addressed or managed through supply chain kind of issues, because if you essentially kind of declog the economy and you have always more and more people making goods, then obviously supply is not an issue. So it's a broader economy related questions, but it's surely at the end of it, we always talk about inflation beating returns. Fixed income, it's hard to beat inflation, rarely does it beat inflation, and therefore equities becomes really the kind of place to be. And normally, when inflation is relatively measured, I mean, I'm not talking of hyperinflation, but when inflation is there, that's actually augurs well for corporate earnings, because that gives them the ability to essentially achieve growth, essentially to kind of price more than the inflation rate. So normally, history has proved that steady inflation augurs well for corporate earnings, which in turn results into higher equity returns. The challenge becomes hyperinflation, and the second implication inflation has in terms of the currency rate. If you essentially have higher inflation versus, say, the United States, where practically the global interest rates are set in, then that's bound to kind of result into depreciation of the currency. So it has implications for both corporate earnings, equity returns, and your currency.
Just to add what Nilesh has said, and you would enjoy this example, one of our neighboring countries, for example, has a very high rate of inflation. The currency is depreciated, and the stock market has surpassed India's by a long shot in terms of the absolute level of the index. The country is Pakistan. The index is 125,000 at the KSE stock exchange out there, because the currency is depreciated. Inflation is very high. So obviously asset values have to go up to compensate for that. So if you're a stock market investor, you're doing pretty well. If you're a regular citizen, you're getting poor every day because money is buying less and less. So inflation has very funny effects on how it, you want, when in inflationary time, to be in inflationary proof assets, real estate, commodities, stocks. You don't want to be in cash.
Yeah. Okay, we just have time for a couple of more questions.
Yeah. So, why don't you go ahead?
You already asked one. Did you ask one?
Yeah.
Okay, no, so then let's give a chance to someone who's not asked. Right there at the back.
Hi, my name is Yuk Kothari, and I have a question for all of the panelists. So currently, for students, if we have time, do you think it's a good idea to even start investing in cryptocurrency? Because there are a lot of problems there are a lot of new challenges, there are a lot of new things that are happening in the world. So there's no guarantee about which currency is falling and how the stock markets are getting affected. So what do you think about cryptocurrency being a possible alternative?
Have you tried investing in it, or have you thought about it?
Yes, I've thought about it a lot of times, but I have always just stopped at the end.
I thought I'll start in sometime.
My short answer for that and my long answer for that is don't do it. Okay? I have a very strong view on that, and despite it being so popular right now, despite Trump saying it, Elon Musk saying it, whatever you say, it's basically my version of the emperor has no clothes. It's a speculative bubble. Go back in history and read about the South Sea bubble, the Tulip Sea bubble. I think that's the one that's playing out. My suggestion to you is find a great equity business. Feel you're owning that business, whichever business you want, rather than owning something like a cryptocurrency. I'm very clear about it. It's against popular opinion, but I would strongly, if you were my son coming and asking me, I'd say avoid it.
Because at this point, even Jio is trying to get into it with the Geosphere and all of that.
I mean, popularity is popularity. You can't...
what is Dad saying?
I have not actually asked that. I've started investing in all of that, but cryptos, I'm researching and then I'll ask.
Okay. Nilesh?
My simple answer is that because you are students and, in the world of academics, invest only into something if you can measure the value of it or estimate what could be the value. If you can't do that, just don't do it. Everything else then is just speculation. So trying to say, okay, crypto is today, whatever, Bitcoin is $100,000, it will be $200,000. That's like kind of speculating on the price.
He's absolutely right.
I think what you should, and especially this is going to be very, very important for you, and this is true for stocks as well. If you can't essentially estimate or measure the future value of a stock, do not invest into it. As an investor, if you do, then that's speculation. So that's true for cryptos, it's true for gold, it's true for real estate, it's true for anything.
Prashant sir?
No, very well put already by Ramesh and Nilesh. I've myself always been hugely skeptical of crypto and always been wrong so far and might continue to be wrong, but I'm still highly skeptic. I'll ask to you if you really have done the work to understand what these cryptocurrencies are and what they derive their value from. So at first, I've not been able to understand, but you should, if you're interested, spend the time to understand that. And if you truly understand, please do explain to me as well. And maybe I'll change my mind.
Okay, last couple of questions from people who've not had a chance yet. Okay, yes.
Yeah. So I'm Muskan, I'm from NMIMS Mumbai doing MBA. So in the earlier discussion, the topic of FIIs was there. So my follow-up question is regarding that only. As an investor, I would want to know that how important is their role for Indian market and has it changed over the period of time? Are we expecting a change because as domestic investments is increasing in Indian markets? So what is the current status and future outlook?
And your question is to?
Nilesh sir.
No, I think it's important. I mean, clearly, undoubtedly, all investment is welcome. Domestic investment, foreign investment, all is welcome. And so there's honestly should not be any differentiation whether it's domestic or foreign. I think FPI investment is important. We do run a trade deficit and it has implications for essentially our current account deficit. One way to plug that is to basically getting foreign investment. Obviously FDI I would probably think is the most important because it's a direct investment into a business which creates jobs, it creates employment, it adds to the economic activity. But that doesn't undermine the role of FPI investment. I think FPI investment is extremely important and we should welcome it and do whatever it takes to promote FPI investments.
Nilesh, a few months ago, let me go to 6 months ago, we were all talking about how because of the robust domestic investment coming in through mutual funds, FIIs have not been as important as they used to be. At one point they used to move the market, now we are self-sufficient. Has that kind of changed in the last few months?
No, at least I think obviously if that was a view, that view was I think misplaced. I don't think we are at that stage where we have adequate amount of capital back home which can take care of our requirements. We are a growth economy, we will need lots of capital and all capital is welcome, whether it's domestic or foreign. It's just that maybe at some point of time we think the domestic capital is more important, at some point of time we may think that the foreign capital is more important. But I clearly believe that if we want to kind of ensure that India remains a high priority global investment destination, clearly all kinds of capital is welcome.
Okay, I think we have time for just one more question. You want to go?
So, sir, my name is Shauri Gupta and I am an MBA student at School of Business Management, NMIMS Mumbai. So my question is that National Infrastructure Pipeline outlined ambitious 102 lakh crores for sector encompassing energy, roadways and railways and others for urban development as well. So now with government's focus on fiscal consolidation, there is a limited scope for increase in public spending. So is government looking to reintroduce something like tax-free bonds to encourage private investments?
Good question, Sharan. Well researched.
They probably will do that because I met a few of these financing companies over the last few weeks, and they will raise money through external capital borrowings, through tax-free bonds, through a mixture of products. They'll probably do that, and I think you're right. The kind of structural thrust that is going to take place in infrastructure will probably be shaped in this budget. We'll probably start seeing in this budget because this is not an election year budget. Government has 4 years to run, so they will have massive amounts of money coming in, and that needs to be financed, and they'll have to find multiple ways to finance them. So yes, I do think that'll happen.
Okay. All right, we'll wrap it up here. Absolutely last question there.
Okay. Thanks for letting me ask the question. Good afternoon, sir, and good afternoon, sir. So my question is regarding taxation. In India, about 6.7% of the population files taxes, but at the same time, the government needs to drive growth in the taxation. So how can a government take steps in this budget to not burden the current taxpayers, but also improve the growth in taxation?
Wow. I think that's a question we've all been asking for years. I'll ask Prashant to answer it.
I think, see, again, no specific remedy here. It is a highly, trillion or $4 trillion question, if you will. Government, in my view, should A, simplify the taxation policy, and B, broaden the tax base. It is politically not easy to broaden the tax base, and that's why I think the importance of GST and somewhat differ here from what Nilesh said earlier. Yes, in an ideal world, we would want to have lower taxes and lower or no taxes, but the government has to collect taxes, and if you can't politically broaden the income tax base, then GST is the best means to broaden the tax base. So I think that's something that we cannot reduce, because if we were to reduce GST, the burden would fall further on the small 6.7% that you said, because we can't reduce the burden. In democracies worldwide, and India is no exception, there's no evidence that governments have been able to reduce the tax burden. And I'm hopeful that under Elon Musk now, they come out with some formula that sets as an example for other democracies to reduce the tax burden, meaning to reduce the government spend. But if we can't reduce the tax burden, and we must collect the tax burden, must do it efficiently and in a broad-based manner, and GST helps in doing so. I would hope that the government doesn't increase further taxes on the equity markets. We are one of the highest already in the world, and doesn't increase taxes on entrepreneurs. We are again one of the highest in the world effective tax rate.
Okay, there you have it. Well, that's the view on, Trump, the potential impact, where we are in terms of markets, what we can do, and of course, a lot of implications of not just the upcoming budget, but also of several government policies that potentially stand to take shape over the next few years. But I reckon that we can now conclude this particular part of our conclave. I'm going to take a moment to thank our experts in the panel here, Mr. Damani, Nilesh, as well as Prashant, for coming here and speaking to not only our viewers, but also the audience here, and of course, addressing a lot of these questions. But I reckon that we can stop right here, but don't go anywhere. We'll take a small break, and we'll be back with yet another very, very interesting panel on the other side. Stay tuned in. Back in just a bit.
I present the budget for a historic.
Well, Budget 2025 is around the corner and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for, no change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they are expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced on gold, silver as well as platinum. There will be no reversal on this as per Macquarie. Moving on to the next space, pharma and healthcare, potential support for higher R&D via tax reduction can take place, and PLI for anti-diabetic and weight loss medication could also be one of the factors that the budget might consider. And modest increase in allocation for Ayushman Bharat is something that Macquarie is expecting from the pharma and the healthcare space. Infra is the next space. Capex allocation for key ministries like railways, roadways, etc. Can be expected in this budget, and announcements around additional dedicated freight corridors can also be expected in this budget 2025. Defense is another area where initiatives to boost defense exports can be expected, and announcements around that will be expected, and initiatives fastening domestic defense equipment procurement could also be one of the things to watch out for in this particular budget. Lastly, in terms of power, green energy thrust to continue. Steps to promote initiatives across the value chain, that is to promote green energy, might also be seen during this budget. Oil and gas is the last counter where Macquarie expects that OMC's compensation for LPG under recoveries might be seen. So these are Macquarie's expectation on different sectors as to how budget may come out with different changes in different sectors and how it may impact these sectors.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know. Hi, thanks so much for tuning in. This is the Investor's Guide on NDTV Profit. My name is Alex Matthew and with me is Mahima Vajrajani, and we've got a great panel lined up for you over the next 1 hour. The conversations between retail investors at the start of September last year were largely about bragging rights. How many multi-baggers do you have? And also things like, I have a 30% XIRR. What about you? That's all changed, and maybe people are a little more cagey about their portfolios right now. We've seen correction in the Indian equity market, particularly at the broader end, and portfolios understandably have taken a knock. But where do we go from here? Is it all gloom and doom? My guests today on this special Investor's Guide on NDTV Profit do not think so. In fact, things are looking up according to them, and over the next hour, we'll give you insight so that you know how to position yourself ahead of the union budget. We have with us today Gautam Shah, founder of Goldilocks Premium Research, and Kush Bora of kushbora.com. Thank you so much, gentlemen, for joining us. And of course, also in studio with us is a very special a bunch of people. In fact, we've got a lot of aspiring anchors, maybe investment analysts, maybe, and various other things. They'll tell us later what they intend to do. But we've got students from NMIMS, MBA students from NMIMS, and also members of our own research team in-house. And so they're going to ask questions. we will soon have a WhatsApp number flashing on your screen. I'm pretty sure that we'll have that right now. There, we have it right now. So you can send us your messages and your questions so that Gautam and Kush answer them when we get the chance. But before we do, let's set the context. Gautam, what I was talking about, and I hope I set the conversation up for you. We were talking just before we started this, and you said it's not all gloom and doom. Why are you saying that things are looking up?
Well, Alex, I think there is a concept in technical analysis called reversion to the mean. And I think if you didn't question the madness on the way up in the months of August and September, you shouldn't question the pessimism on the way down. And I think this will just make the market healthy. And if you really look at the last 4 years, there have been multiple corrections that the market has handled. You know, there was an 18% drop within the bull market in late 2022. People questioned the bull market, markets came back, and you had the best rally, you know, the next couple of years. And I think the world continues to be in a strong bull market. We've had our own local headwinds, but chartically, I do believe that this entire fall that has happened, I think will just make the market a lot more stronger. And on the longer term charts, I really don't see a concern. So this is not the time to throw in the towel and be negative on markets. Yes, there could be more near-term volatility, but with the Trump factor, with the budget event ahead, with the RBI policy, I think these are events that can potentially trigger that rebound that everybody is looking for. So if your view is more 12 to 18 months, there is every reason to be optimistic. But if you want to make money at the markets over the next few weeks, maybe it might not be a good time to be active.
I think that's the much needed optimism after the kind of downfall that we saw today. So I think the investors or viewers that are watching you will be, you know, right now jumping on their sofas or chairs probably. Kush, do you also affirm to the view that Gautam has?
I do. In fact, I remember it was Wednesday when we had the closing show, and you know that's when I first time said that there's a good possibility that a near-term bottom is in place. And I'm not saying that the worst is over and this downfall is completely done and dusted, but I'm saying there's a possibility that we could revive from here, maybe extend this short covering rally that we saw on Wednesday and Thursday. And just to add to something what Gautam was mentioning, you know, what we've seen is a bit of a double-edged sword kind of a behavior. We've seen the SIP numbers, they've come in strong, correct? Which means a lot of retail investors came into the market after the 2020 COVID issue that began. Now, what's on the other side is the derivatives trading, that began. So we're seeing both sides of the coin. Now, what's happened with that is a lot of investors, even traders for that matter, have not seen a longish period of correction, what we call as time correction, right? Every time the market dipped, about 2%, 3%, 5%, you saw a revival almost immediately in the next 2, 3, maybe 4 sessions. This time around, the pain is prolonged, not only in terms of the price movement, but also in terms of the time correction that we are witnessing, and hence all these queries and chatter. I do believe, if you believe in the nature of cyclicality of things, this is a blip, maybe an extended one from what everyone's used to for the last 4 years, but this is a blip in a longish bull run that we've had for the last 4 years.
Okay, so I asked both of you gentlemen to give me some perspective on the way that you've been looking at things chartically, the data that you've been studying, and also this is meant to give investors a glimpse of how you study the markets, how you take your decisions, and you both sent us some charts. So we're going to try and pull that up on the screen while you explain to us what this is about. The first one that you sent me has to do with divergences that have emerged over the course of the last several years. What can you tell us about that?
So if you look at the monthly chart of the Nifty, everybody is busy looking at 30-minute charts and 5-minute charts and daily charts. So I'm looking at things longer term, because I think real wealth is made when you stay in trends over a period of many weeks to many months to many quarters. Right. So when you look at the monthly chart of the Nifty, and I take the last 25 years, markets have always topped out when there is negative divergence, which means price makes a new high and the indicator does not make a new high.
So we have the chart on the screen. You want to explain that?
No, this is a different chart. Can we have the correct chart, please?
Which one are you talking about?
The monthly chart of the
monthly
Nifty.
Chart of the. Let's pull up the monthly chart of the Nifty 50. Anyway, go ahead.
Yeah. So the key point which I was trying to make is that in this fall that we've seen, the RSI on the monthly chart actually made a new multi-year high in October 24.
Yes.
right? And we've seen this cool off that has taken place in the last 3 years. And I'm giving you data of the last 25 years. And that's probably the reason we strongly believe that this is the correction of the last big run that you saw last year, the madness as I defined it. And post this, the men have been separated from the boys, and you will have quality stocks coming back. So I'm quite convinced that if you're not looking at things very short term, just based on this chart here, I do believe that over the next 18 months, you could actually see the Nifty going back to lifetime highs. So I wouldn't be negative. The margin of safety is in your favor. You get to buy stocks at your prices, something that you've not got in the last couple of years. Make the most of it. Don't shy away from this opportunity.
Right.
Just want to bring Kush in because he's also sent us something on the RSI. Do you want to make the point that you were making?
Absolutely, very similar, in fact, very similar, which is the divergences do play out very strongly. A lot of people just get a little lost in analyzing, where the RSI is headed or where the markets are headed. Well, actually, the kicker lies in the combination of the two. Saying the same thing. In fact, let me give an example. It was around July 2023 when the Nifty monthly RSI hit 83, 84 odd levels, and this was, I think, the second or the third highest that it has ever hit, right? And on this channel, we were here discussing the same thing, that this is overheated territories on a monthly basis. This is not going to last. This is not going to sustain. Those divergences popped up on a monthly basis, which wasn't a healthy thing. And from there on, we've seen a correction. Of course, the markets did go up a little further before they moved, lower, but there were hints. Now, I'm going to go a little granular than Gautam, which is on a daily basis, you are seeing some positive divergences. While we await confirmation in terms of the key resistance levels taken out, we are seeing some divergences on the daily RSI chart versus the Nifty. That plus there are a couple of other factors also put together, which are suggesting that there could be a short-term, short covering rally at the very least, and an extended one at that, which could perhaps take the markets higher from these levels.
Right. Gautam, you've also sent a chart which suggests the percentage of Nifty 50 stocks which are above the 50 SMA. How are you reading those, and what does one make out of that chart?
In the textbooks of technical analysis in 1970s, it was written that a 20% move on the index or a fall in the index is defined as a bear market. We've fallen 12% on the Nifty, but if you ask people on the street, they're already feeling it as one of the worst bear markets that India has ever seen, because the damage has been really large. So the best way to understand the market trend or the sentiment is to look at the breadth. And the percentage of stocks in the Nifty which are trading above the 50-day moving average is somewhere around 25%. So as the Nifty is actually making new lows, more and more stocks are not participating on the downside, at least in the Nifty 50 and the Nifty 500. So this is what we call as breadth divergence. And whenever this has emerged in the last 4 years, markets have always bottomed out. I'm not saying that we're going to be all well tomorrow or in the next 1 week. All I'm trying to say is that these are not levels to be extremely bearish. This is probably an opportunity, and the data is backing it. All we want now is a confirmation on the price action. The studies are all aligned, telling you that we could be close to a possible bottom. Maybe worst case, you could see another 4% downside. But if and when the Nifty gets past 23,500, for people who want to look at things over the next few weeks because the budget is here, I think that would be the real price action confirmation that all is well again.
Right. Is there any sectoral trend that you're observing along with this, percentage of Nifty 50 stocks that are, moving? I mean, seeing it's moving above the 50 SMA.
See, with what has happened in the last 4 months, fundamentals don't matter. Smart money doesn't matter. Sectoral Ps and all those metrics don't matter because everything has come under the hammer in the last 4 months, right? And that's the beauty of it, because you now have an opportunity where everything is being painted with the same brush. And I'm sure a lot of investors in the market are doing their homework as we speak, trying to pick that next move up. So I'm pretty sure the domestic money, which has been on the sidelines, is waiting for stability. The moment stability comes, you will have a lot of pockets, particularly financial services, auto, real estate, FMCG. I think these are my preferences, and I think they'll come back strongly.
Gautam, you've been keeping your powder dry. And have you been keeping your powder dry, and are you deploying now?
I think now is a good time to be fully invested. I think we've had just enough pessimism, and I've backed it with a lot of data points. So I think between now and say the 1st of February, you want to be fully invested. You don't want to think that this is going to continue for the next 6 to 12 months. I'm not in that camp.
Okay, but you're buying for the next 12 to 18 months at the very least, right? You're not in it for the next 4 weeks. I'm just establishing that point.
I don't think so, because even at the COVID bottom of 7,500, people said that the world is going to survive.
Yeah.
And if you bought at 7,500 thinking that the world is going to survive, you got a great opportunity over 2 years.
Yeah.
Nobody knew what would happen over the next 2 to 3 months, but the world took care of itself. So I think markets and local and global factors will take care of themselves, because see, we live in a connected world. Globally, US markets near lifetime high, Singapore near a 4-year high, European markets, London near a 52-week high. In that kind of backdrop, you can't have India going out of context.
So, okay.
Go ahead. Yeah, Kush, like what he said, do you also, he said auto, real estate and FMCG, he talked about the consumption space overall, which has been kind of beaten down, in the past 1 year, 1.5 years. On the charts, are these your sector picks, or do you have a different view?
So just before that, while we are optimistic, I just want to caveat this, with what I said earlier. I am a little bullish for the next few weeks, perhaps months, right? But I don't think this downturn is over. While we want to remain optimistic, we want to remain cautiously optimistic. There is a possibility that the Nifty might perhaps see a short covering rally and then perhaps give way. And hence, while Gautam's all in, I would perhaps, as you said, keep some powder dry. I would deploy at this point in time, but I wouldn't go all in, because for me there is not that confirmation just yet that all is over and we're hitting a medium-term bottom here. Okay. What I meant was maybe in the near term, in the next few weeks or so, there could be a possibility of a rebound. But do we go ahead from there, or do we see some more correction and test new lows, is something that I would want to see when we get to that point.
I think the beauty of reading the signs and studying the data is that you can have slightly differing views, in fact very differing views as well. Yeah. And the only way to know when you're right is to look in the rearview mirror, and you're always right when you look in the rearview mirror. So, but what we're trying to do is provide a little bit of context ahead of a major event, and that both of you gentlemen have agreed could be the fulcrum that takes us to the next level, right? And I think to a certain extent, the finance minister is quite aware of what is happening on the ground, and quite a lot can change. You're looking at a situation, and I know, gentlemen, you're not looking at that kind of data perhaps, but you're looking at a situation where capex has not happened to the extent, and maybe the last panel was talking about this, right? Yes. And that really is where the money is going to go. Whether there's a break in the budget for the individual taxpayer and whether that bolsters consumption is something that we have to yet wait and watch. But the bottom line is that there is going to be spending on the capex side, and that is going to push the levers of the economy forward. But from that perspective, there are a couple more charts that you shared with us, Gautam. You want to talk us through the next one?
Which is
you can pull up whatever and we'll try and pull it up for you.
Yeah, so I think if you look at the market action of the last 4 months, you'll be amazed to know that 75% of the stocks in the NSE 500 have lost more than 20%.
There is actually a table. Let's pull up the table that Gautam has shared with us, and it talks about the number of stocks that have been beaten down, and 75%, as you pointed out.
And 40% of the stocks have lost actually more than 30%. So that's the kind of damage, and I'm only talking about the NSE 500, which is a benchmark for a lot of funds in the market. If I actually look at the balanced 1,000 stocks, it's only going to get worse. So the key message is quality has actually stood out. I mean, I keep giving this example of Indian Hotels, probably one of the brands which we all relate to pretty much on a day-to-day basis, is still near a 52-week high. So if somebody stayed in quality over the last 6 months, he would have been safe. Secondly, I think it's only for people who got into the market in 2024 who are really complaining about this fall. But if you are somebody who came in 2020, 21, 22, 23, actually there is no reason to complain. Because a reversion to the mean, a correction, is really a part and parcel of the bull market. As you said, the street is divided. I'm happy it's divided, because I think we were all in the same camp in August and September talking about the India story and the Viksit Bharat. I'm sure it's all applicable, but you needed a reality check, and that reality check has happened.
And the camp that said, "Mera paisa 3 saal mein double ho gaya." No?
Yeah.
23%.
Yeah, I think it's our generation that's kind of right now disappointed. But I think people who have stayed in the markets and know how the markets work are not probably complaining, like you rightly said. Kush, since we're talking about budget, railways, defense, in the past 6 to 8 months, they've seen, a downtick because they'd seen a significant, up move. But we are now expecting that this budget would probably have more capex allocation towards the railways, the defense, and the infrastructure sector. Today, if let's say not today, but in the next 1 week, just before the budget, if somebody wants to pick up some of these few counters, what would they be?
And just to round up the question that you asked me earlier, which is on sectors, that I like, just a quick one on that. I like the agri space, which could very well receive some boost, in the budget. And I like the housing space, but in particular housing finance, not the developers, not the ancillaries just yet, but the housing finances. So just to round up on that question. Now, very interesting question, because everyone's got their eyes on the railway space, on the defense space, hoping for some allocation. Now, what's already happened is that some of these stocks had already run up. If you see the last month and a half, 2 months, these stocks have already run up, but we've not seen that follow through. So while I remain a little optimistic on some of these names, I think these are the spaces where you have to remain a little cautious as well. Because with all that hope built in and some price action already seen into some of these names, if it doesn't come through, then I think they will perhaps see some disappointment on the price front as well. But if it does come about, then the stocks that I have on my radar, BEL from the defense space is obviously one of them. We know it's been doing well. It's not even cracked as much as the other defense stocks had. So that is definitely one of them. From the railway pack, JWL, Jupiter Wagons Limited and Texmaco Rail, these are some of the names that I've got on my radar. The only caveat here is that, we've not seen that follow through in the price action, so that could perhaps be a bit of a worry. And if nothing comes about, then all the hope that's built in might perhaps get a reality check.
Do our guests in the studio have any questions for us? And if so, I would encourage you to raise your hands and let me know you have a question. Can I get a mic to him, please? In the meanwhile, I'm going to take one question from WhatsApp, which is, sit down for a minute. In the meanwhile, I'm going to take a question from WhatsApp because this is an interesting one. At a time when we're talking about budget and pre-budget strategies, we've got Sridhar B. He hasn't told me where he's tuning in from, but he's asked, please suggest some budget agnostic investment strategies. Gautam, you want to answer that?
Not really.
Kush? That is a brilliant question. Let me start with that. Because, look, we've seen in the past, it's an important event, but the impact of it pretty much lasts a day, maybe two, on the markets. We see that volatility, we see that action maybe on the following day, but then it just fizzles out. So that's an excellent question. I think what I have on my radar are some of the heavyweights. Reliance, we've seen a bit of a drop already. HDFC, we've seen a bit of a drop already. So some of these names, you've got safety as well in them, in the sense closer to support zones and already corrected quite a lot. So if your view is anywhere 6 to 12 months or longer, I think these are some of the stocks that you want to keep on your radar, agnostic of the budget.
Okay, just want to make a quick point. If you're tuning in at home, use this opportunity to try and fine-tune your strategies, to ask the gentleman here how you should read the data, because of course you'll get strategies on how to invest through the week, and I'm sure Kush will be back next week. Maybe we can get Gautam as well to give you a few strategies, but now you should think about how you can employ the strategies that they're also using and plan accordingly.
And we've got the finest people in the industry here,
Absolutely.
so this is your chance to ask them.
You've got a question?
You have.
So my name is Vyomkesh Bhatt. I'm from NMIMS Mumbai. So my question is to Kush that, Kush sir, as you told that the agri-space and housing finance sectors are like your favorite for investing. After the union budget will be announced, which sectors could be the ones that would be profitable or could see a boost in their markets?
Sure. First up, Kush is fine. Sir makes me feel a little older than I am. And second of all, I am also a part of the NM group, by the way. So yeah, good to connect with you guys. See, after the budget, I mean, as simple as it sounds, it's once the budget is announced, we'll know which sectors are going to be favored. Right now, we can only talk about the anticipation. But if I add a couple more names to that list, it could actually well be the auto space. Seeing what kind of push do you get on the green engine, green auto push. So some of those names could also well be added. The fertilizer, again coming back to the agri theme, some of the fertilizer names could get added to that list. So agri and home finances, as I said, perhaps an outside chance of the auto sector also receiving some sort of a push is what I will look out for in the budget speech.
All right. You also had a chart which has compared Nifty 50 with the world index. Would you like to throw some light on that, Gautam?
It's actually a very important chart because in the last 4 years, India has used to outperforming the world. So if you compare India versus Hong Kong or India versus China, India versus US or India versus Europe, we've always done well. So we took pride in believing that we are one of the best performing markets in the world and also one of the fastest growing economies in the world. So they all moved hand in hand. In the last 3.5 months, for the first time in 4 years, India has moved a different path and the world has moved a different path. And obviously with Mr. Trump coming in, US markets are feeling a lot more excited and they've done really well. If you look at this chart, what you'll understand is that the Nifty versus the world index chart, so the MSCI puts out a world index chart, that is currently at a 2.5-year low. So this chart is telling you that this disconnect which India has had with the world is likely to end because we are at a major support. And for the first time in 4 years, this entire correction is not imported. We always blamed somebody outside the nation for our corrections. Probably this time, for the first time, we have our own local issues, which can be handled very diligently over the next 2 weeks by the government and by the RBI. So I'm hopeful, and if this chart has to work, then I think India will have to be aligned with the rest of the world, and the world is not going to be aligned with India.
Just to follow up on that, in the previous panel, we were discussing that there was a point of time when there was a debate that, the DIIs are buying everything that FIIs are selling, and which is why the markets were stable and moving upwards. But now there has been a point where FIIs are selling more than what DIIs are buying. Where does the conversation go from here?
Let's be clear, FIIs have been on the wrong side in the last 4 years. It's just in the last 4.5 months that maybe they are proved to be on the right side, but they pretty much missed the entire rally because they have been questioning the India story for the last 4 years. And domestic money is a revolution. It took us 25 years to tell people that please don't park your money in debt funds or in FD and please move to equity markets, given all that has happened in the last 25 years. In the last 4 years, whenever there has been a correction, we've always questioned whether SIPs are going to stop. It did not stop.
Never.
We had 2 major geopolitical developments last year. People said that, okay, is there going to be a problem in the world? SIPs didn't stop. So why are we questioning now? Because I think the moment you have stability on the screen, the domestic money will be at play. But which are the stocks that will do well? Top quality. So my key message to your viewers is please stay with the top 300, mid cap 100, small cap 100, and the Nifty 50 and the next 50. You will be sorted. There is no way you can lose money buying those stocks.
Okay, let me fine tune that further then. And maybe you can come and Kush immediately after that. Is when you're looking at these 300 and the basket is pretty wide even here, at this juncture, what are the factors that are helping you decide, and what are the key data points that you're looking for that help you decide, okay, now is the opportunity that I'm going to take a bet in this stock?
See, Indian markets historically have topped out when the PE is about 27, 28.
Right.
If you look at 2000, if you look at 2008, I mean, I speak about it as a technician, but then these days you need to look at everything. Today, as we speak, we are at a 21, 22 PE on the Nifty and the Sensex, and we are at a 13, 14 PE on the Bank Nifty. So there is no way we are in fraud territory, which has been the case for a lot of people. So keeping that in mind, I want to buy value. I don't want to buy growth. We've seen what has happened to Asian Paints and many such stocks in the last 4 years. There's been enough debate around it. They were extremely expensive. New competitors came in. There was disruption, and a lot of high PE stocks could not sustain. But you have an SBI at a 9 PE. You have a Bajaj Finance at a 13, 14 PE. You have a Hindalco, which is at a low double-digit PE. I want to buy value. This is the time to buy value in the top 300.
And I think this is the perfect time, like we were discussing yesterday on the show as well, that stocks which are performing good in terms of earnings and have lower PEs are kind of outshining the market despite the markets seeing such a huge sell-off. But the stocks that have had high PEs but good results are still seeing the beating. So it's clearly a market where you buy at discounts. That's it.
Yeah. We were talking about Republic Day discounts on Friday, and I guess that holds true. based on what Gautam is saying. We have to slip into a very quick break, but on the other side, I would invite you to ask more questions. We'll take all of them on the other side, and I'm sure our special guests in studio have more questions for us on the other side. So do stay tuned. We'll be back before you know it.
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about three key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme, where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at source, or TDS, as things stand right now. And the mutual fund industry is suggesting that this threshold be raised to 50,000 rupees, and they expect that this will benefit a lot of people because they won't then have to have tax deducted at source. Of course, there are more proposals that they've made, but we'll see what the finance minister takes up when she presents her budget for 2025.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the
watching Investors Guide with NDTV Profit just ahead of budgets. For viewers who are just tuning in, we request you to send all your queries, with respect to trading strategies that you would want to adopt from a budget perspective as well as from a longer term perspective, because we have, best of industry panelists on our show today who will be answering your queries. So do take that opportunity and ask all your queries. Kush, I'll come to you. You've done an option chain analysis, and we'll pull up that chart as well. Two-part question. Sure. What do you make of that chart? And secondly, we have a young audience here from NMIMS, and we're seeing that despite of the kind of disclaimer that all of these, brokerage apps are giving that, 9 out of 10 investors make losses in F&O, youngsters are still moving towards F&O. What's your advice to them?
Let me take the second question first. Are you still interested in F&O? Okay, so a lot of
resounding yes.
It's a resounding yes.
Yeah.
So a lot of measures that the exchanges have deployed are on the right track. At least they've eliminated the weekly expiries. A lot of them, at least not all of them. Yeah. But look, as a firm believer of, you must try whatever options are available to you in terms of the financial products as a knowledge or as a hands-on experience. Yes, you must. Should you go overboard? 100% no. I still believe in Warren Buffett's statement of derivatives are weapons of mass financial destruction, unless used wisely. And what do I mean by wisely? They were meant as hedging tools, correct? So as long as you've got a right strategy in place, as long as you're using them as hedging tools, then they just might work for you. If you're using them as speculative tools, then yeah, all the very best, right? Yeah, so that is the first thing. Secondly, there are tools, and the reason I like derivatives, I also watch derivatives data very closely along with the technicals, is because derivatives is immediate money flow action witnessed on screen, right? So just to give you an example, if you could just bring up that options chain table, that we saw. If you understand call, put, open interest, stuff like that, which I'm sure you do, what you will see is if anyone's selling a lot of put options, that there is a base forming around that level. If someone's selling a lot of call options, and by someone I mean the entire market, right? So on that data, if you'll see, the 23,000 put off late has had a very significant addition of open interest. Now that base itself, the open interest base itself is quite strong and high in number compared to whatever call option base is there. So that gives you an immediate sense. Now it could well happen that something comes up in the market and the market just slips below 23,000. But for the most part, we've seen that level being respected, right? So these are some of the data indicators that you track very closely just to get a sense of where the money is flowing in the market. So should you do derivatives? Yes. In limited quantity, as a part of your strategy of an entire overall portfolio, as a speculative trade, not so much. But yes, you must definitely watch the derivatives data to get a sense of where the money is flowing today.
I want Gautam's view on this as well, because he's indicated that he has, and I'm pretty sure you have a strong view on this.
Yeah, because there are a lot of youngsters who've come into the markets in the last 4 years. I've had the pleasure of seeing 2008. Everybody is fearful of 2008. I saw markets collapse 70% in about 10 months. So I've had the pleasure of learning.
You're giving me palpitations just thinking about it. So please don't.
But the bigger
and I
point
hope it doesn't come back. At least till we are alive.
No, those environments, that environment was very different. But the key point is, do you really want to catch one mega trend, or do you want to catch 10 mini trends? I think with F&O trading and short-term trading, it's about trying to catch multiple trends over a period of 3 to 6 months, which I think is very difficult. Why? Because markets are very complex. AI is here, and artificial intelligence will ensure that your strategies don't work consistently over a period of time. Had this been an era a decade back, I would have said, go ahead, do leverage, do F&O trading, because you can be on top of the game. But with AI, I'm telling you, markets are going to be a lot more complex. Secondly, India's greatest investor, late Rakesh Jhunjhunwala, said, I do F&O, I do leverage so that I can create that capital to invest for the longer term. So I don't know of too many people who've created serious wealth over the last 20-25 years doing F&O trading. So why you as youngsters should get into it? Try and catch one mega trend. And Indian Hotels, the Taj brand, you catch one of these trends over the last 5 years, and you make serious money. So don't work hard. You don't need to work hard in the markets. You just need to use some basic common sense and technically use a concept of moving average or moving average crossover. And believe me, you're sorted.
Okay. So, and that's very good perspective. I'm just reminded of that movie Of course, everyone's watched it. All is well, right? Okay. Let's say that for now, because we don't want a 70% drawdown as things stand right now. But there's an interesting question that has come through on WhatsApp, and this is from Ketan Shah, and you spoke about quality. I'm going to read this out, right? Considering that large caps have had a flattish run for a while, and I think that is a good question because for a while, and in 2024, there are a lot of people screaming from the rooftops, shift out from the broader markets, move to quality. But unfortunately, that has not panned out yet. Would you see any opportunities at the broader end? Would you say, like you said, 300 stocks, but would you gravitate more towards those large caps?
I think with the kind of dip that you've seen in the last 4 months, quality mid caps and small caps, I think probably present the best opportunity. Quality large caps will also do well, and within the quality large caps, look at the stocks that offer value. And I think margin of safety is very important, and I do believe at the current juncture, many of the top large cap stocks can actually give you mid cap returns. I think gone are the times where when you spoke to somebody, you asked that, okay, is the stock going to double? I think you need to lower your expectation as a market participant. And if you're able to generate a 20-25% kind of a return from now, say till 2029, till the next general elections, I think you should be good. So mid cap, small cap, but stick to top quality. That's probably the best opportunity.
Interesting one. Let's take one of our, there you go. Yeah, you can go ahead with your question. Yeah.
Hi, so my name is Tanvi Nadkarni. I'm from Mumbai, NMIMS. My question is that with the increasing use of AI when it comes to trading, is the Indian stock market more vulnerable to risks? And how would you advise new investors in ways that they could leverage AI when it comes to investing, considering all the risks involved as well?
You want to take?
So I think, I don't think there are risks. These are enhancers. I think when the Badla system was stopped 20 years back, people didn't know how the markets are going to survive. And then F&O came into play. AI, I think, will just make trends a lot more complex. And we've seen in the recent past how rapid the moves are. And because the moves are rapid, I don't want youngsters to actually look at those 15-minute, 30-minute, and 75-minute charts. Go more daily, weekly, monthly. And if I have to give you a concept, something which I have used over the last 20 years very successfully is the moving average crossover system. Just backtest it, and whenever you get moving average crossovers, buys and sells, you will be on the right side of the trend 70% of the time. So AI is just making shorter term trends complex. AI has nothing to do with longer term trend because that's a structural trend that's going to play out.
Yeah, and it's data that the regulator pointed out. I don't know if y'all caught it, and if you watched NDTV Profit, everybody tuning in at home, the regulator simply told you a short while back that based on the data that it collected, the only people that made the money in trading F&O were the prop traders. It was not the retail trader. It was not the individual trader. And there was also, by the way, an interesting data point that talked about women trading. And the thesis at the time was, oh, women are losing less money
than men.
But interestingly, there was another theory that said that these are guys that are trading on their wives' accounts. But I don't know how true that is.
I don't think that's true. I disagree with that.
She disagrees with that. And I believe her entirely. Okay.
Right.
Does anybody else have a question?
I think one more question from our very own researcher we'll take.
Yeah, thank you so much for that. Yes, I'm Rucha Somaya and work with the NDTV team. One question, Gautam, to you is that you mentioned that Nifty might make new highs in the next 18 months specifically, and now the current blip, as Kush mentioned, is a kind of reality check. But my particular question to you is, do you really think that this generation has actually seen a crash? I mean, we are the ones who've started investing after COVID, maybe invested in lows, and now we've just seen all-time high, and we've not known what 2008 was actually like. So is this just a blip, or does this generation needs to see a kind of crash, and do you think one is around the corner?
See, better late than never. Had the markets continued the way they have for the last 4 years, at some point of time, this correction had to come. I think a lot of people started to believe that an uptrend is our birthright, and this is going to continue, till the time we survive in this world.
That's what Mahima mentioned, right?
Yeah, so I don't think that happens. I think corrections, large large, small, are a part and parcel of the bull market. I think a lot of people will now realize that, okay, something like this can also happen. But I think the bigger message from the market, again, I keep saying the same thing, that if you stuck to quality, you are still better off. I think we saw the SME madness in the middle of last year. Everybody felt that SME is the next big thing, and now look at what has happened in the last 6 months. So a lot of things are seasonal, a lot of things are structural. Focus on the structurals. And while I'm not sure whether we'll make a new high in 18 months, I do believe that the downside potential from here is 4% and the upside potential is about 20 to 24%. Now, even if it has to take a little more time, it can. I do know that the risk reward is in my favor as an investor, and I'm not looking at the market next 2 weeks.
Maybe one statement question. What kind of returns do you think the market can give this year? Can give this year?
It's not this year. It's actually a 2-year call. What is it?
I said 18.
See, I think 24% is definitely entirely possible. I don't think that's the right way to approach markets. I think if you're able to do, say, 2.5 times inflation or 2.5 times the current FD rate in the market, you're doing very well for yourself. I think we've all forgotten how to be conservative. I think this is the time to be conservative. And the most important point is the world is in a bull market. Right, and in India is still growing at will grow at close to 7%. Domestic money is here to stay. I know we look at the screen and we get very nervous, but believe me, the screen doesn't take time to change color.
If your SIPs, by the way, and to the point that you made right at the start, which is that those people that had started investing in 2021, 22 or 2020, and if your XIRR or the rate of return that you're getting on your portfolio is still at 17, 18%, man, it's a reason for you to cheer. It's a reason for you to be happy. But there's an interesting question from Harish Wagh. Has the bull run ended? And are we at the start of a bear run? I think to a certain extent we've established that, but Kush, you want to comment?
I have a very clear answer to that. The bull run has not ended. This is a dip. And I think a lot of viewers at home, especially the ones who've seen a lot of red in the portfolio in the recent past, are probably not going to like it. When Gautam and we say that this is healthy. What happened in the market over the last few months is healthy. We do share the pain. We are invested in the same market as you are, right? So we do share that pain. It's just that look at things from a broader context, right? Most investors who started investing now, as I said earlier, have not seen such a deep price correction, have certainly not seen such a time correction, and that's where the pain is. Things have a way of evening themselves out, and Indian markets certainly have a way of rebounding much stronger. So I think this is I will reiterate that this is a blip in a longish bull run, the likes of which we had not seen in the last 4 years. I think much better times are yet to come. Stay invested.
Right. Gautam, one question to you. It just clicked to me in the last panel. One of the members from from NMIMS asked about cryptocurrency. It was an interesting one. He says he's studying crypto. His father's not loving him, apparently. But, today's generation, after FNO, it's cryptocurrency that they're looking after. And cryptocurrency has no base as such to look at. But since you are the ones who are experts in reading the charts, do you advise entering cryptocurrency for youngsters like, who are just 20, 21 odd years?
See, anybody who has been against cryptos in the last couple of years must be looking at the prices today and must be feeling, oh, what a rally I missed. But I do believe that crypto is something which is not everyone's cup of tea, because you could be down 10, 15%, 20% in a single day. I don't think youngsters should be ready for that kind of volatility. In fact, we as market professionals who've done this for the last 20 years also don't feel comfortable. But another asset class, another commodity, which I think is in a mega bull run, and I think is something which youngsters should look at, is gold and silver.
Yes.
I think in the Trump era, given geopolitics, given all that's happening in equity markets, I think gold and silver are going to beat equity market returns over the next 2.5 years.
Talk about the relationship with the dollar as well, and the flows there, because generally when they say that the dollars, and we've seen it come off quite substantially towards the latter end of the trading week, right? Where nothing major came through from the perspective of Donald Trump's announcements. But of course, you look at the dollar and you look at the yields being elevated in the US and say that maybe to a certain extent gold prices will be a little bit muted. But as soon as that turns, you're looking at an upside, right? Are you looking at that?
I'm looking at a very big move on both gold and silver. I do believe that a 3,300 is coming easily. Maybe at some point of time in the next 18 months, you even see a 4,000 on gold.
Wow.
And I do see a $42 to $45 on silver. So that's 25, 30, 40% upside, which I don't think a lot of large cap stocks in India are going to give you.
Yeah.
So I think that's an asset class which you cannot ignore. I do know a lot of people are now deploying serious capital, even in SIP, in a gold and silver, which has worked.
Because ETFs are available for you.
Yeah, ETFs are available and there is a basis. 10 years back, it was not the case. But I think coming back to your question, we had a triple whammy because rupee has been depreciating, dollar index appreciated, and the crude appreciated. Given all these factors, India was in a situation where it couldn't handle all three together.
Yeah.
Now you've come to a point where it looks like the dollar index is going to cool off. Given the statements from Trump, it seems as if oil is going to cool off. And I think rupee has already seen a parabolic run and it seems that it's going to at least stabilize. If that happens and if the earnings stay strong and if the budget is reasonably good and there are no shockers, we digested capital gains and STT beautifully. Can it get worse? I think no. It doesn't look like, as somebody with common sense, that it can get worse. Hopefully it only gets better and we get some good news on 1st February.
Gold prices, by the way, in the international market at $2,771.39 per troy ounce. And the call here is for a 4,000 per troy ounce possibility over the next 18 months, which is quite substantial. Yes. I'm curious about whether you track crude as well, and we'll come back for a question, but crude is the other big talking point for us here in India in a situation where the rupee has been weakening. Of course, towards the latter part of the week, you saw a rebound. Yeah. But crude prices, do you look at it, Gautam?
Not so closely on a daily basis, but a general sense where the idea is that they might perhaps cool off a little bit. But since I don't track them on a daily basis, I wouldn't.
Do you what? See, I think a rising crude is obviously negative for our economy, something that we've studied in the books and we've felt it at the markets in the last 20 years. Yes. I'm very happy if crude stays in a range. It doesn't go down much, doesn't go up much, because then we don't need to work hard or look at those intermarket relationships. Yeah. With all that has come from Trump, it looks like crude is definitely not going to, move through the roof. Yeah. More chances that eventually it breaks down below 65. And if that happens, it's going to be great for our economy and for our markets. I think markets are not discounting that at this point of time, but it could happen. So number-wise, 65 to 85 on the NYMEX crude is where I see the action happening. Any move, either way, you could see the next big move coming in.
Interesting.
I think let's take one more question from the group of students that we have today. Yes, go ahead.
Good afternoon. My name is Dishita and my question is for Mr. Kush. As you mentioned that derivative strategies are something that you go for. So what derivative strategies would you recommend to manage risks post-budget and what specific strategy can youngsters adopt?
Why post-budget?
Because budget is coming up, any post-budget specific, and you can give in general as well.
So, no, the reason I ask is because budget is the day of volatility. I mean, or at least expected to be. So if ever you needed derivative strategies, it would be the day of the budget or maybe just prior, just to hedge your portfolios or just to hedge your trading positions. I am not someone for very fancy 3-legged or 4-legged derivative strategies. I think the incremental gains to be made, or rather the gains to be made out of such strategies is rather incremental only. Hence, I suggest very basic ones, which is covered call or a covered put, depending on what your view of the market and what your position is. If you want to get a little more fancy, then you've got the spreads, bull call spread, bear put spread, things like those. Stick to these. At the end of the day, what really matters in the market is the view that you have. If your view is right, then it is only about how do you maximize your profits based on your correct view. Now, that could be by playing options, without any hedges, which I don't really recommend, or by playing via spreads, where your profits go down, but so does your risk, right? So apply very simple strategies. 4 or 5 of them are just fine. Covered calls, covered puts, bear call spread, bull put spread, or just a variation of these. Not too fancy. It just sounds very interesting. It's a good conversation, but it doesn't really give you as a bigger return as you're hoping that, they just might. So,
thank you.
Any more questions?
Go ahead.
Go ahead.
Hi, I'm Kea. So as beginners, as young investors, we do not have a lot of money that we go in and invest into the market all at once. So initially, maybe we would put in 25 to 50,000.
Wow.
That's maximum. Maybe less so. It depends from person to person. But with that amount of money, you're usually looking at only 1 or 2 or maybe 3 to 4 stocks to choose and invest in. So how would you recommend us to choose those 4 stocks out of a full market of various stocks in various industries?
Good question.
See, I've always
the questions for anyone.
Yeah, so I've always learned in the last so many years that you buy stocks that you understand. You buy stocks whose businesses you understand. There are a lot of products that you use. I mean, we all talk about Zomato today. We all talk about ITC today. We all talk about Indian hotels today. These are products that we understand. So I think the first thing that you could do as beginners is to only invest in products that you understand. And you feel that these products are going to stay over the next 5 to 10, 15 years. If the answer to that is yes, simply go and invest. You don't need to make things complex. You know, these days there is this notion that I'm going to do rocket science and all kinds of strategies to make money at the markets. You just need to catch a simple trend. Zomato was a simple trend because people believed that India cannot survive, you know, without a Zomato. I think it's a behavioral change that we saw in the last 3 years. And so that's the key message. Invest in businesses that you understand, you know, from a common sense perspective.
And I guess consistency as well. You want to come in on that? Because a lot of people, the worry is, and I know that you've spoken about the retail investor deploying money into the markets, SIP mode. A lot of people have spoken about the flows and the durability of that over the course of the last several months. But some people have also voiced the concern that on a one-year basis, if people see their portfolios not doing too much, there might be a little bit of disheartening feeling coming through. So what would you say, because you both have so much experience and consistency that you've built into your practice, is that one of the most important aspects to bring to the table?
So one saying which I found very interesting about markets is that stock markets are based on economic principles largely, right? I mean, be it macros or be it even stocks for that matter, right? But stock market itself is a place which does not follow the economic principle, something as simple as a demand and a supply, which is where the supply is excess, the demand just vanishes, right? I mean, when we see stocks falling, no one's willing to go out and buy, right? When we talk about SIPs, what I'm happy about is what we were having as a discussion, which is even if the markets haven't really performed well in the last 3 months, this may or may not be the 4th month of a negative click, correct? The SIPs haven't really stopped as much. They've not gone down, fantastic. They've not stopped. They don't increase, it's fine. But at least, you know, people who've been doing it have maintained that. So when do you really buy something? I mean, most of you, when you shop, right, on online apps or malls, you shop when there is a sale and a discount, right? Why do you want to stop your SIPs when the markets are actually giving you that discount? This is the time to either double down on your SIPs or maybe at least just maintain them. Now, there is always this argument कि और नीचे भी जा सकता है. Of course, जा सकता है. But at least you know that you're buying 10% off the highs, 20% off the highs, maybe 30% off the highs, depending on your stock, correct? So this is the time to maintain your SIPs or probably even double down.
See, I just want to add here one important data point. The Sensex was at a level of 3,000 in 2003. That 3,000 became 21,000, that's 7 times at the height of 2008. 7 times. In that bull market of 5 years, where a lot of people made serious wealth, you had multiple 20-25% corrections. You also had 3 circuit filters. I still remember May 2006, May 2004, and October 2008. So you had 3 circuit filters. So volatility is actually part and parcel of the game. In the last 4 years, actually there's no volatility. Because if you're going to be scared with a 10, 12, 13% correction on the index, I'm sorry, stock market is not the place for you. And the more it falls, as an SIP investor, you should be happy that, you know, you're buying quality stocks at good prices. And we've seen in the last 4 years when the turn happens, it's so quick. People have short memory. They forget everything of the bad times.
Interesting. Do we have any more questions from the panel? Yes, Rucha, go ahead.
We have one at the back. Why don't we give him an opportunity?
Sure.
Hi, my name is Yuk Kothari, and the question I had is, after this dip, how much of a high do you expect before the next dip? So like, if we were to buy right now, or even in the next 2-3 weeks, how much do you expect? How much time do you expect it will stay as a high?
I don't think even astrologers can predict that. But
can I ask you a question? Sure. On today is the 25th of January.
Yes.
On the 1st of February, at what time exactly will the sun rise and what will be the highest temperature in Mumbai?
That is
So then how can you expect them to answer that question?
So I think the sun will rise and the trend will, and the trend will remain.
It will be around 28 to 30 or 32 degrees Celsius in Mumbai. That
See, look at margin of safety. That's the key point at any point of time. You know, when the madness was on in August, September, the margin of safety was not in your favor because we knew that we were buying stocks at very elevated levels. Right. There were Excel sheets written that in 2039, this will be the earning of this company and therefore I'm going to discount it. I'm going to give you this P and that's the reason it's the stock price. Right? So look at the margin of safety. If the margin of safety is comfortable, don't lock yourself as to how high it will go. A late Rakesh Jhunjhunwala ji held a Titan over 20-21 years. And you know, a lot of youngsters are talking about F&O strategies. I think you must be in the camp that which is the next 5-7 stocks which I can hold for the next decade. That will create serious wealth for you.
Okay, we have one more WhatsApp question from Abhirami. You know talked very highly of gold and silver, but her question is that instead of investing in gold ETFs or gold directly, should one invest in gold stocks like Kalyan Jewellers?
I don't think so because that will lead to a lot of volatility. We've seen what has happened to Kalyan. Yes. At the same time, for a long period of time, Muthoot Finance was the direct proxy to gold. Oh, yeah. And look at what Muthoot has done in the last many years. Yes. So you buy direct proxy stocks, that's number one. Yes. Why make trends so complex? Gold, silver ETFs are there. It was not there a decade back. We couldn't invest. Okay. When that option is there, reduce volatility and go towards ETFs.
And and of course, from the asset allocation standpoint, a lot of people keep telling you don't go crazy about your gold investments. Have it in your portfolio. Yeah. I don't know if you. So So I speak to a lot of advisors, personal finance investment advisors who say 15% is okay, 10% is okay. Do you abide by that?
15 is a very good number.
15 is a good number. All right. So that gives you perspective as well. Even if you. You're betting on the gold story, don't go overboard. I guess that's the story for anything that you would do in the investment sphere, right? Don't go overboard.
Don't go overboard, don't be too concentrated and don't be too diversified. I think that's the bigger problem.
What's the definition of too diversified?
So I think everybody has a different definition. For me, anything more than 15 stocks is being overly diversified.
Okay, so it's
right. And there have been many people who've banked on 4-5 stocks and did very well for a long period of time. And now as the tide has turned, they have realized that they were too concentrated. So if you have to ask me a sweet spot, I would say 12 to 15. I mean, as many of the greatest investors say, they don't have too many children whom you cannot manage. I think in the same concept, don't have too many stocks which you cannot assess, analyze and follow on a daily basis.
And not all of them will be Page Industries with 45,000 rupees, so therefore 46. So therefore, to the earlier question that was asked about how to deploy 50,000 rupees, I think that's plenty. Wouldn't you say?
Oh yeah.
50,000 rupees per month, Kush?
To begin with, it would have been a dream back in the day when we started.
Any number is good. There is no definition to any number. Any number is good. Everyone starts slow. Even in the earlier panel, when you spoke to Ramesh ji, I think everybody started slow. It's how you play those trends over a period of time. And I think the India story is here to stay for sure.
And if you are an MBA student at this juncture and if you're thinking of deploying money into the stock market, then I know for a fact that you're going to be a success story in the next decade, right? Because a lot of people realize a little too late that they should have deployed. I certainly started only when I was 30. And investing has been very fruitful over the last 5 years.
Correct.
Yeah?
If we have one more question to take, I think, there you go. Backside. Yes, go ahead.
Yeah, so you can, like a regular investor, if I ask
Please introduce yourself first.
Sorry, I'm Sai and from NMIMS. Like when the Nifty was around 26,000, I asked my dad, you can withdraw some funds, it has been a long time. But my dad was like, I would only hold it, I would not add more. But, what would be the rationale a fund that I can invest, which would even look at the pessimistic side?
Okay, so what you're essentially asking is, if I interpret that correctly, you want to give your money to someone who decides when to take money off the table, is that right?
Yeah, but even bet going down.
Bet going down. So that's what mutual fund managers or managers of your money would do. That is why you deploy money into mutual funds, because you want a professional manager to manage your money for you. But I think there's a part of that question which is interesting, which is at what point on the way up do you decide when to hit the sell button? Because booking profit is as important at some points as buying low. Who wants to take that?
I think you need to have a target return in mind, that on this idea, if the company does this, and if the stock price comes to this point and say it hits a 25 or a 30 or a 40 PE, I will look at taking money off the table, because you don't want to get out early as well. A Zomato from a 50 became a 300. So a lot of people started questioning Zomato at 150 or 200 based on the market cap. So I think the idea is to ride it, have a financial target, have a trend target, and I think you'll be sorted.
Okay. You want to come in?
I want to come in on this one in the sense that you see, nobody knows where the stock or the index is going to hit a high, correct? But you know when it's coming off. So I'm a very big fan of something called a trailing stop loss. If you've seen the Nifty go to 26,000 and your target was 24, you don't sell at 24. You move your stop losses up. So from 24, if it goes to 25,000, 25,500, 25,600, you keep moving your trailing stop losses higher by 500 points. Hypothetical, this is just a number. The concept is more important. So you won't catch the top for sure when it comes to selling, and you won't catch the bottom when it comes to buying. But trailing stop losses will help you. Yes, of course, I wanted to sell at 24,000. Now it's 25 off the highs of 26, but I'm still making more than what I actually originally planned for. So trailing stop losses are a great way to decipher when to exit. Slightly lesser profit, but profit nonetheless.
I know. So since you're both chartists, and I want to end with this, you spoke about certain data points that you watch that will allow you to deploy. On the upside also, there should be some data points that you watch should say that it's oversold right, or it's overbought right now. You should book some profits. Is there can you point out to 2 or 3?
On the upside, we are not taken seriously when we talk bearish. I think in October, I remember putting out a report where I felt that this is a market that just cannot move up at the same, continue at the same pace. And then you had the big fall because nobody wants to believe you. And right at the bottom as well, if you're talking optimism, nobody wants to believe you because the environment is so scary. But I think looking at the data of the last 25 years, it's very clear that trends will play out. These ups and downs will happen. You will get dips from time to time. The key message is, do you want to get sucked into the shorter term trend, or do you want to stay with the larger trend? I firmly believe, looking at the chart right now, there is no data point that tells me that we've seen a mega top in October 24. That's the key message. If that is the case, even if we go slightly lower and if this continues for another few months, it doesn't make a difference.
Yeah, because in any case, people are investing in the long-term growth story. Kush, last word?
Well, similar, the reason I keep coming back to this, July 2024 monthly RSI report is because we also put out that report and we spoke about it on the channel as well. There are indicators. Trust me, there are indicators. It's just that Gautam rightly said, when you speak about this, no one wants to believe it because of the environment. But even if you pay a bit of an heed, start cooling off a little, or maybe, sitting on cash, those indicators are always there. It's just that how seriously do you want to take them? So yes, there are indicators. It's just that, whether you choose to act on them or not.
So we've spoken about several
one very quick point for your viewers is risk management. Because I think a lot of people let go of risk management thinking that, all is well, markets cannot correct. But those people who did not have that seat belt on, when you sit in the car, you put your seat belt on because in case of any eventuality, it protects you. Similarly, stop loss, I know, is a dirty world in the world of trading and investing. But let me make it a lot more fancy by saying risk management, which is actually a stop loss. And if you don't adopt that, then I think the market will take away all that you've made. So I think that's one very key point for every trader and investor, know when to exit.
When Donald Trump was taking charge last week, Tamanna said in the opening show, seatbelt kaskar bandhna chahiye. But I guess that is the case most of the time. You should have a seatbelt.
And I think that's something that the young investors should really adhere to. A stop loss is something that will, lead to bigger wealth going forward as well.
I've said this on the show as well. Stop losses are God's gift to mankind. So just go by that. It's as simple as that.
Limit your losses over the long term. It's more important than the alpha that you can generate, right? All right, so I think we've got quite a few insights on this investor's guide, and I'm sure that a lot of you sitting at home have also benefited. Of course, these gentlemen will be back over the course of the next several weeks to give you more insight. And thank you so much to the both of you for joining in and for providing us with that insight. Always a pleasure having you. That brings us to the end of this particular segment, I will say, of the Investor's Guide. We've got more lined up for you in just a short while, so do stay tuned.
I present the budget for a historic.
Hey everyone, with Budget 2025 right around the corner, there is one question on everyone's mind. Will this finally be the year salaried individuals get some much needed income tax relief? Let's dive into the story behind the tax slabs, the rising cost of living, and why economists are calling for reforms. First things first, Budget Day is set for 1st February 2025. Expectations are sky high, especially among salaried individuals. But before we talk about predictions, let's rewind a bit. The first big moment for taxpayers was back in the Union Budget for FY 2020-21. That's when the government introduced an optional personal income tax regime with lower tax rates but fewer deductions. Remember that? It shook things up for taxpayers who had to choose between the old system with deductions or the new simplified one. Fast forward to 2023 budget, Finance Minister Nirmala Sitharaman made some tweaks to the new tax regime, expanding 2 income tax slabs and increasing the standard deduction from 50,000 to 75,000. Sounds promising, right? But here's the thing. It didn't touch the old regime at all. So what exactly is standard deduction and why does it matter so much? Think of it as a fixed amount you can subtract from your taxable salary. It's meant to help with everyday work-related expenses. While it's been raised over the years, the question is it enough to combat the rising costs we're all facing today? Did you know the standard deduction was actually scrapped back in 2005, but it made a comeback in 2018 at 40,000, and since then it has been climbing steadily. Now economists have a big ask for Budget 2025. Cut income tax rates. Why? Lower taxes means more disposable income in your pocket. That extra cash could boost savings, increase spending on essentials, and even revive demand in sectors hit by sluggish consumption. Sounds like a win-win, right? In fact, during a recent pre-budget meeting, experts suggested exactly this to Prime Minister Narendra Modi, arguing that it's time to ease the financial burden on taxpayers while stimulating economic growth. As per an NDTV Profit exclusive, the upcoming Union Budget could bring significant income tax relief with potential modifications to the new tax regime. Sources suggest the government is considering adjusting personal income tax slabs and reducing tax rates for incomes up to Rs 10 lakh to boost disposable income. The new tax regime, which restricts exemptions and offers fewer deductions, is already the default option for taxpayers, with 72% having shifted to it. Notably, the July budget increased the standard deduction to 75,000 and revised both tax slabs and rates. Under the new structure, income up to 3 lakh is tax-free with progressive rates ranging from 5% to 30% for higher income tax brackets. As Budget 2025 nears, there are growing expectations for reforms aimed at easing tax compliance, particularly for NRIs, that is non-resident Indians. Here are the key suggestions highlighted by Deloitte. Firstly, simplifying the tedious process for property transactions involving NRIs. Currently, buyers must withhold tax at a higher rate, obtain a TAN and file ETDS returns. Introducing a challan cum statement system similar to residential transactions could streamline the process and reduce the burden on buyers. Second, enabling tax payments from overseas bank accounts. Presently, tax payments must be made through Indian banks, making it cumbersome for NRIs. Allowing payments from foreign accounts would enhance convenience. Third, improving e-verification by extending OTP options to foreign mobile numbers. This change would simplify tax filing for NRIs, reducing paperwork and eliminating the dependency on Indian mobile numbers. Lastly, facilitating tax refunds to overseas bank accounts. Refunds are currently credited to only pre-validated Indian accounts, which can be problematic for NRIs who no longer maintain accounts in India. Allowing refunds to foreign accounts would ensure timely processing and avoid issues with dormant accounts. These measures would not only simplify tax compliance but also make the system more accessible and efficient for NRIs. So here's where we stand. The last union budget didn't shake up the old tax regime but did make the new one slightly more attractive. But will Budget 2025 bring bigger changes? Will we finally see reduced tax rates or higher exemptions? Only time will tell. Until February 1st, the speculation continues. But what do you think? Drop your thoughts in the comments below and do not forget to like, share and subscribe for more Budget 2025 updates. See you next time.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome to Investor Guide Budget 2025 special. This is going to be an interesting one because not only our speaker is interesting, but our audience is also absolutely interesting, who's actually wanting to know what should we do from here on. Welcome Saurabh Mukherjee, founder and CIO at Marcellus Investment Managers. Along with him, we also have the students of NMIMS Students College in Mumbai and our very own researchers at NDTV Profit. Guys, you're getting a great opportunity to be a part of this conversation with Saurabh because he himself has started his journey without knowing anything about equities, and this was in his 20s as well. So I'm sure you're going to be able to connect with him very quickly. Saurabh, first thing, we are just around the budget. the key that everyone wants to know is, how is investing ahead of the budget different from regular investing?
I think, look, all event-based investing, whether it's monsoons, budgets, elections, all event-based investing is inherently risky because you've got a certain take on the event. So some people watching this might say that I feel the budget will be expansionary, right? And that sort of investing is very risky because making a right call on a specific event, whether it's monsoons, elections or budget, is very tough. So I would urge those watching to use the budget to understand the state of the country. For youngsters like this, it's a great opportunity to learn about how the economy actually functions, but wouldn't recommend trading around the budget, shorting the market, buying stocks, selling stocks around the budget. That's sort of, if you want to do that as a hobby. Don't do that with an expectation of making money.
But with everything said and done, when you say that, do it as a hobby as well, do you think it could be a learning experience where a new time trader, a new time investor, I would say, would be able to limit their losses to an extent when they know, okay, this is the money that I'm going to allocate, this is what I'm going to learn out of it, and probably if I lose this, I shouldn't be crying over spilt milk then.
So the only challenge with trying to learn investing through through events like the budget is there are so many moving parts inside the budget. Even if you make money on the back of it, you've got no idea whether you made money because you read the budget right or because something else happened in the world that day to make you go right. So I stress again, event-based investing is difficult, it's risky. If you want to do it as a hobby, consider doing it, but as making money out of specific events like the budget or the monsoons, in my 20 years of being in markets, I haven't seen too many people do it. But that said, it's a great opportunity to learn about the country and about the economy.
So what should an investor do, and to make the most of the budget, how should he or she navigate from here on? Because clearly when you talk about not looking at investing, taking specific events into consideration, but all of these events hold a lot of importance when it comes to markets, right?
Sure.
So to look at an event, take for example, you're talking about the budget now. You had Trump 2.0, which has come at play as well. You've spoken about Modi 3.0 as well, but everyone has been looking at these events very closely. So what should be that perspective be then?
So I'll give a very simple framework to think about long-term investing and the budget being one of the items in a long-term investing framework. So one of the most rudimentary things we learn when we begin our investing career is, जब economy down cycle में जाती है, when the going gets tough for the economy, think about defensive, in inverted commas, sectors like IT, pharma, FMCG, right? That's kind of investing 101 in any country. In a down cycle, think about IT, pharma, FMCG. Now, either basis you're reading of the newspapers or watching NDTV, a viewer might have formed an impression that the economy indeed, after three good years, to F22, 23, 24, the Indian economy has entered a cyclical downturn, right? So that's a mental model you build. If you tell yourself you've entered a cyclical downturn, it makes sense to buy IT stocks, pharma stocks, FMCG, even I'm not 100% sure, but high quality banks would be my third area, IT, pharma, high quality banks. Now, so my hypothesis is economy thandi ho rahi hai, down cycle mein ja rahi hai. The budget is an occasion for me, is an event for me where I can either get my thesis validated. The FM will talk about both tax collections and her hope for tax collections for the year ahead. She'll have to give some economic commentary. There will be the economic survey published the day before the budget. All of that gives me information on, is my perception that the economy is in a down cycle, is that perception correct? If it is, it gives me greater confidence that I'm on the right track by buying IT stocks, high quality banks and pharma stocks in bulk over the last 3-4 months, right? I'm not expecting to make a ton of money on the back of the budget, but I have a mental model of the economy and the budget gives me information on, is my mental model correct, or have I got my thinking awry about where India is going?
Right. So that's the way you should be looking at the markets whilst reading the budget. Ahead of the budget now, with what's happening in the markets, you've seen a significant correction that's already coming in after the upcycle of the last 4 years. And this is something which is warranted, right? You cannot avoid a down cycle in the markets. How do you tread from these kind of events? And do you think these opportunities should be used to invest in markets and pick pockets of growth or pick pockets of value?
Right. So I think economic upcycle and downcycle are like summer and winter. You don't get worked up because the economy is going down, just like you don't get worked up because summer is ending and winter is coming, right? What you try to do is make money through the cycle. And as we were discussing, a simple framework is, as we go into tougher economic circumstances, which could last for 1.5 years, you load up on sectors which are more export-oriented, IT being a classic export-oriented sector, pharma being an export-oriented sector. And in my case, I've chosen high-quality banks because high-quality banks had a rough time in the post-COVID rally, and I think their time has now come. Now, over and above that, there's another way to think about this, right? India and America are the world's best performing markets over the last 10 and 20 years. These are the only two markets which have given double-digit dollar returns over 10 and 20 years. But the even better news is not only are these the world's two best markets, these markets have very little correlation with each other, right? So when India struggles, America does well. When America struggles, India does well. And therefore, if you're able to build a portfolio which is, say, half India, half America, it actually gives you much better chance of generating superior long-term returns, right? Just to use 2024 as an example, calendar 24, our market struggled, the Americans did well. I think over the next couple of years, the Indian market is likely to have a tougher time. Over the next couple of years, the American market is likely to have a happier time. So as we go into an economic down cycle, other than buying export-oriented sectors like IT and pharma, it's also worth figuring out how can I invest abroad. In our case, 2 years ago, we started investing abroad through a portfolio that we opened in Gift City. Our team in Gift City invests into America and Europe. And we think that's a great opportunity to consider, right? The rupee is giving up value to the dollar at roughly 3 to 4% per annum since 91.
Correct.
And that naturally means that if you earn, say, 15% in dollars, it becomes more like 18-19% in rupees, right?
Terms.
So beyond looking at export-oriented sectors in the Indian stock market itself, consider taking a sort of mental flight into America and look at companies, not just the Magnificent Seven, not just Amazon, Microsoft, but go down the batting order and look at high-quality American manufacturing companies. Gift City makes that very easy for all of us to do.
And I think with Trump 2.0 as well, where he's clearly indicating that he wants to make US the manufacturing hub, and is talking about tariffs that either you're manufacturing in the US or look at tariffs. That's going to be interesting. But let's also get in all our students who might have questions on this aspect of the budget as well as Trump 2.0. Let's go with, who has the mic over here? Yes, you can take the first one. Introduce yourself and you can take the first question.
So I'm Harish Sarda, and I'm an MBA student at NIMS Mumbai. So, crude oil is one of the largest imports in India. So, in the vision of Viksit Bharat, so how would replacing a significant portion of oil imports with renewable energy or with domestically produced ethanol contribute to the balance of payment equation or the economic growth?
Yeah. So look, lovely question. I think one of the beauties of our country is because services is 60% of GDP, and services grows much faster than the broader economy. Okay? Services is the largest part of the economy, and it grows much faster than the economy. And because services is not particularly energy consumptive, right? To run an IT services company, you don't need a lot of oil, right? That's meant that India's oil import bill, as a percentage of GDP, has actually steadily come down over the last decade. I remember 10, 15 years ago, it was around 13% of GDP. It's now 7-8% of GDP. So my reckoning is, given that it's highly likely that services will be the leading part of our economy and highly likely that the services sector will grow faster than the broader economy, I think as it is, this is a natural construct of the economy, will reduce the energy bill as a percentage of GDP. So I'm not in that camp which aggressively wants the government to give subsidies and do chillana baji to promote alternative fuels. I think the natural construct of our economy actually is one that reduces the importance of fossil fuels, because we are largely a services-oriented economy, and our services sector is actually very competitive, world-class. All of you probably would have heard about global capability centers, right? So Microsoft, Google, Wells Fargo, JP Morgan, all of these firms employ lakhs of people in India. So every week, 3 new global capability centers are opening, creating 30,000, 40,000 jobs, right? So the entire world's office work is coming to India, which is great news. because that sort of office work is lucrative work, अच्छे salaries हैं, good salaries, and it doesn't need a lot of energy consumption. So I think there's plenty for the government to do. It's a very tight, tough fiscal situation for the government. I think the tax dollars are better spent in stimulating the economy in other means rather than worrying about the energy transition. Not least because Trump himself has said, immortal words from the US president, drill baby drill, right? So the US president is saying drill baby drill, and we are here jumping up and down about methanol. थोड़ा सा odd लगेगा.
Yeah.
Hi sir, I'm Juisha Gandhi.
Hi there.
So what you said about drilling down, using that only, the agriculture is other basis of rural consumption in India is one of the key drivers, right? So sir, how do you think this budget will focus on their or increasing financial access to rural communities, or in general credit access to most of MSMEs or marginalized communities?
Superb question. So this is let's now use this to contextualize why the budget is so good. So if you read India's income tax data, right? It's freely available, income tax data. I would strongly recommend everybody goes to the government websites and understands how the income tax data works. Those earning between 5 lakhs per annum to 1 crore per annum, right? They pay 75% of India's income taxes. But that's only 4 crore people, right? Just 4 crore people pay 75% of the income taxes. And where do those income taxes go? They go to those who earn less than 5 crores. 80% of India's population earns less than 5 crores, the folks you mentioned. They are the big vote banks for our political class, right? And I think the message that the political class has taken on board over the last 12 months is that percentage of the population, those people who are below 5 crores, are really the only politically relevant people, right? We have 64 crore voters in India, out of which 4 crore are in that middle class segment. So you can see politically it's really irrelevant. The income tax paying population, they pay taxes, people like us, but politically we really don't matter. The people who matter are the people you mentioned. So my reading is the next 4 or 5 years, across political parties, there'll be a rush to give goodies, freebies, rebates, subsidies, doles to people below 5 lakhs. I think this budget will have some of it. Obviously, as we approach the 2029 general elections, that will ramp up. And as an investor, and this is why budgets are useful to learn, right? Not because of you want to trade on the budget. As an investor, you start building a mental model कि सरकार गरीब को पैसा बांटेगी, and what stocks can I buy? कहाँ पे निवेश करूँ जिससे मेरी कमाई हो? That I can earn on the back of the government being generous to the poor, because they are the only people who politically matter, right? So lovely thing. That's exactly how you need to start strategizing around the budget. हाँ जी, आप चूज कीजिए.
I'm Muskan. I'm from NMIMS Mumbai. My question is that government has a goal of Viksit Bharat by 2047, and infrastructure investment plays a major role in that. Last year we saw in budget there was an investment of 11 lakh crores going into the budget. What are your expectation out of the budget this year, and what do you think is an ideal amount that is required for India given the roadmap ahead?
Right. By the way, I should say at Marcellus we are big NMIMS fans. We have got several Narsi people in our...
Yes, NMIMS. Yes, yeah. It's a tongue twister.
So I think you have to be practiced on that, yes. Right? So we have several Narsi people in our office, and you guys are clearly very well prepared for this, and I'm happy that historically Marcellus has recruited from Narsi. But coming to your question, right? I think infrastructure investing के लिए पैसा निकालना will be really tough for the government. So let's again do some basic math. Nominal GDP, right? This is real GDP plus inflation, is going to grow at max at 10-11%. Okay? So nominal GDP will grow at 10-11%. The government has been very clear. They want to reduce the budget deficit. Abhi 4.9 is F25 में 4.9 के आसपास आएगा. They're probably going to try to get it down to 4.4, 4.5. Now, if they want to reduce the budget deficit, total government spending will be growing less than 10%, right? If your GDP is going to grow at 10 and you want to reduce the ratio, तो जाहिर है आपका total government spending is going to grow less than 10. Now, if it's going to go less than 10, will you really be killing yourself to spend on infrastructure, or will you look after core vote banks, which is the 80% of the population? I think the lesson that has been learned at the general election, the 24 general election, was look after vote banks. Infrastructure spending, I think, increasingly becomes secondary. And all those in the stock market who have loaded up on infrastructure stocks, I think really need to rethink their obsession about government capex oriented stocks, because I simply can't see, given the political realities of India, I simply can't see where the government will find the money to spend on infra, given that critical vote banks have clearly shown that if you do Ladki Behan, you get immediate political dividends, right?
But Saurabh, to this point, I'll come in over here is, as much as the vote bank is important, I think the money-making process for your population is also important, right? And a lot of people are becoming dependent on the stock markets for the same. To that, if we are talking about, okay, an infrastructure spend does not mean it's only one avenue. There are multiple avenues where the government has to look at in terms of infrastructure spend. This financial year itself, there has been a delay. They've not been able to meet that number because of elections. They've not met the guidance at all, right? The ambition is, or probably the expectation is, that FY26 mein aayega.
I think paisa nahi hai. So I agree with you, people are thinking like that, but those are the people who don't understand the fiscal and political process. Paisa nahi hai, and that's why I turn to the youngsters again and say, if you do the fiscal math, 10% nominal GDP growth, government wants to fiscally consolidate. Remember, they have to fiscally consolidate in the 2 years immediately after the general election. नहीं तो जब approach करेंगे 2029, पैसा नहीं होगा, right? So जाहिर है, it has to be the case that the first 2 budgets after the general election, July 2024 and Feb 25, these are bound to be consolidating budgets. तो अगर आपकी total tax rate 10% से grow करेगी, right? This year, remember, it's growing at 8. Assume कीजिए अगले साल the tax rate grows at 10, and you want to reduce the deficit, your overall spending can grow at, say, 5. In that context, where will you find money to spend on infrastructure, right? And again, reflecting back on election results, right? Remember, politicians are incredibly smart people, right? They look at election results like, say, we look at our portfolio performance and they say, where did we screw up? What can we course correct? I think the big course correction will be on infra. I think there'll be a far greater focus on benefits for the poor. With regards to the point about the stock market is a big source of earnings, right? It feels like that, right? But again, आप RBI का data देखिए, the RBI has published several times said in the last 6 months, the RBI has said several times in the last 6 months that net household savings, net matlab household savings less household borrowing, is at its lowest level since 1977, right? So it's not even evident that stock market में चिल्लानाबाजी से a lot of money has been made for the middle class. The poor obviously are not going to be the big participants. The middle class are the big participants. But given that the RBI data is so emphatic that net household savings are at the lowest rate since 77, the benefits of the stock market boom, I think, are more likely gone to a concentrated economic elite. In fact, 3 days ago, the Unilever CEO said that in urban areas, debt levels are so high in urban areas that people are having trouble buying FMCG items, right? So it's relatively clear that the middle class is in a tough financial position. But as I said, that's not the core vote bank. The core vote bank are people below 5 lakhs. And recent elections in multiple states have shown that there is a recipe to win votes from them. And I think our politicians are smart people. They'll follow that recipe.
Right. So I think the strategy with regards to investing clearly needs to change from what is expected versus what people are looking at.
That's exactly what the economic cycle does, right? As the economic cycle changes, you go away from, say, public sector capex plays. When the economy is thriving, government has plenty of money, public sector capex plays work, right? I missed out, we at Marcellus missed out because we don't invest in public sector companies. But as the economy slows down, naturally the government has less money. Usually economic slowdowns also make the going tough for politicians. And naturally, when the going is tough for politicians, they turn to gratifying their vote banks. And therefore, if you change your tack and say that in a slowing economy, I'll focus on export wala investing, IT, pharma, and then within domestic investing, I'll focus on stuff that the poor buy. So in our case, over the last 12 months, we have bought companies which make tractors, we've bought companies which make fertilizers and pesticides because we think the big focus will be revving up non-urban India. That's where the power and the votes lie.
Absolutely, power in the hands of rural India, and how the shift in mindset is going to happen from here on, probably to get a developed nation status by 2047 is what we need to talk about next. But let's quickly slip into a short break. Up next, we will be discussing lots more with Saurabh and a lot of interesting questions coming in from the NMIMS students. Stay tuned.
Well, Budget 2025 is around the corner, and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits, and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for, no change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they are expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced on gold, silver as well as platinum. There will be no reversal on this as per Macquarie. Moving on to the next space, pharma and healthcare, potential support for higher R&D via tax reduction can take place, and PLI for anti-diabetic and weight loss medication could also be one of the factors that the budget might consider. And modest increase in allocation for Ayushman Bharat is something that Macquarie is expecting from the pharma and the healthcare space. Infra is the next space. Capex allocation for key ministries like railways, roadways, etc. Can be expected in this budget, and announcements around additional dedicated freight corridors can also be expected in this budget 2025. Defense is another area where initiatives to boost defense exports can be expected, and announcements around that will be expected, and initiatives fastening domestic defense equipment.
Welcome back to Investors Guide Budget 2025 with Saurabh Mukherjee. Saurabh, let's pick it up from where we left before the break. You're talking about rural India, positive in terms of tractors. How are you then looking at consumption as a pack? Because we're talking about a slowdown in consumption, but there has been a slight pickup in terms of rural India, but urban is absolutely something that even the companies are worried about. So how do you link consumption to rural India and tie that together now?
No, you're right. It's very difficult to find consumption plays which only sell to rural. So far we've done tractors, what is Escorts, Kubota, and we've done pesticides, fungicides. So we bought a conglomerate called Godrej Agrovet. Godrej Agrovet has some ice creams and milk and pesticides, fungicides, animal feed, so cattle feed, fish feed, and it also has oil palm. So we thought, let's do multiple rural plays through Godrej Agrovet. You're right, the consumption piece is tricky, right? And one part of what we have tried to do is see if dairy, paneer, ghee, ice cream is a place. So after doing lots of rural traveling in South India, we ended up buying Dodla Dairy around 6 months ago. So that's our main in inverted commas consumption play. But clearly, if urban is slowing, as all the FMCG companies are saying, is urban is slowing, perhaps that will also impact Dodla. So the consumption piece, I agree, is tough because there's no company which only sells specifically to rural, but the tractors and pesticides, fungicides play, cattle feed, animal feed, we thought was straightforward, and hence in our portfolios we have Escorts, Kubota and Godrej Agrovet. I stress I've invested in the same portfolios and so are my parents.
So, but you know, the other key theme with consumption, what happens is everyone's talking about bite-sized. In fact, they're saying that there is a major push where all of these FMCG companies are saying, we are going to sell smaller packs. But that is not what is giving them the bottom line. That's only giving them the top line. Volumes are coming from there, but value is coming only from your larger packs, right? Do you think then the strategy should be where a company has 70% exposure to bite-sized and 30% to, you know, a bigger pack, or vice versa? How should you look at that aspect on a balance sheet?
I think as soon as you see this sort of behavior from FMCG companies, you know they're under the pump. And given where valuations are on the FMCG companies, I think caution is warranted, given, especially since they're being very vocal that they're under the pump, right? So ऐसा नहीं कि वो छुपा रहे हैं. So my suggestion would be just go light on consumption, especially middle class consumption. Load up big time on export-oriented companies. IT, pharma are easy ones, but there are other sectors as well. And then coming back to leaving aside rural, which we've discussed, I would say coming back to the financial system, given that this sort of outlook, right, weak middle class consumption, rising NPAs, tight liquidity, I think liquidity will tighten further. It'll help the high quality private sector banks who haven't done anything really in terms of stock price performance over the last 4 years.
Correct.
I think it'll help them shine again. We've already seen microfinance NPAs go through 10%. We've seen unsecured NPAs go through the roof, right? The RBI had to step in. We've seen credit card NPAs go through 5, 6, 7%, and they're climbing. My travels suggest credit card NPAs are going to rise quite sharply across banks. We've also seen in this result season the beginnings of two-wheeler financing mein panga.
Correct.
Right? So I've done this for 20 years, and all the red lights are going off, ding, 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 ding. And that suggests to me that NPAs across the board, across all lending categories, will soon become a pervasive challenge as we go deeper into 2025. In such circumstances, banks who've been beaten down because they were not sexy enough, I think could stage a comeback. So we are big shareholders in HDFC Bank, have been for many years. I admit we haven't made any money over the last 3 years being HDFC Bank shareholders, but the results that they've published this quarter look to be in a different planet to other banks. In a country where other banks are struggling for double-digit deposit growth, they had 16% deposit growth, and their net NPAs are an order of magnitude lower than even the other private sector banks. So when the going gets tough in banking...
It's the quality that comes at play.
So in banking, I would say there will be a reversion to quality. I'll be astonished if there isn't. But leaving aside banking, export-oriented themes and rural-centric themes, that consumption homework exercise you've given me, we'll try our best, but it is bloody hard to find consumption plays today.
I think, staying with consumption, I think our colleague Puneet, who's in the audience as well today, has a question because he tracks the auto space pretty closely. Puneet.
Thanks for that. So just one question. You mentioned about consumption slowing down. My question was, why is it slowing down? Because we've seen the free grain scheme to 80 crores Indians, a direct benefit transfers, health insurance benefit now via Ayushman Bharat. What is your assessment of slowdown in consumption? And you always write about the women economy where you have plays like Titan in stock performance, but how is that impacted also because of slowdown in consumption? And how would we track consumption coming back as well? Would you see any of the signs that you would suggest in terms of that coming back as well?
So look, let's break consumption up into below 5 lakhs, earners below 5 lakhs and people earning above 5 lakhs. Those earning below 5 lakhs had a really rough time. Demon, COVID, GST, right? The informal economy getting disrupted, they are gradually finding their feet, right? As I was saying, that both in our travels and in corporate results, it's evident that those earning below 5 lakhs are finding their feet. And as is also evident, the election results make it very clear to the political class that if you give money to those earning below 5 lakhs, they will actually reward you politically in elections, right? So that story is recovering, but between 2015-16 to 2022, for 6 years, the below 5 lakh constituency really had a very rough time. I think they're going to rise again over the next 2, 3, 4 years, and we're working very hard to find investments around that theme. 5 lakh ke niche kamane wale log. With regards to those earning above 5 lakhs, I think it's a rough situation because ever since Raghuram Rajan did AQR with the banks in 2015, the entire banking system has focused on lending as much money as possible to the middle class. The middle class is up to their necks in debt. If you leave aside secured loans or unsecured loans as a percentage of income, we're amongst the highest in the world, right? So we've created a very indebted middle class. Job creation for the middle class has become a challenge, courtesy AI, courtesy robotization, mechanization. Jobs for the middle class are proving to be tough, and it's not something government can't sort of suddenly announce jobs for the middle class. That's largely the domain of the private sector. And this combination of the middle class being the main tax piggy bank for the government, slowing job creation and high debt, I think is creating a concerted middle class consumption challenge. Ye utna aaram se jayega nahi. This will take a couple of years. We'll need a rate down cycle. We need a 200 bips cut in rates over 2-3 years to ease the pain on the middle class. Unfortunately, what Trump is doing is jacking up the dollar, which makes it very difficult for the RBI to cut rates aggressively. And that's why I think next couple of years, the consumption story tilts away from class back to mass and below 5 lakhs.
So your assessment of, you said services like IT and pharma will be the next big thing. The government has been doing a lot for the manufacturing to come up in across sectors, and with PLI scheme, do you think that's working on the ground as well? Do you see whatever conversations with corporate India, especially in the EMS space, since it's mobile manufacturing has moved into India, we've become an export from an import destination for mobiles. White goods is the next thing. Do you see those companies, because valuations are very high, but do you think that will drive the employment as well and eventually lead to consumption via the PLI schemes across sectors?
Yeah, so look, I mean, you're right. I mean, in mobile phones and in electronics, it's worked, right? And I think listed companies in that space have done very well. They'll continue to do well, is my reckoning. I don't think the government will give up on PLI. They'll try it. I'm not an expert on why it hasn't been as successful in other sectors. It seems to be a raging success in mobile phones, more qualified success in auto, and uske aage there isn't a big success story. Now the challenge here is the job creation needs of the country are colossal, right? So just to put it in context, every year 10 million graduates enter the labor force, and roughly 20 million people enter the labor force, right? Those sorts of gargantuan numbers, right? How do you create 20 million jobs a year, right? Because giving PLIs to mobile phones or medical devices or footwear can't result in that sort of job creation. So the government's PLI scheme has to be lauded. It's an attempt to create jobs. At the July 24 budget, Nirmala ji also announced an internship scheme, where she said, I think BSc 500K companies have to do 5,000 interns per company. It'd be great to hear on 1st February how that internship scheme went. But even there, you can see 5,000 per company across 500 companies. You're still creating a few lakh jobs, not the millions of jobs that 20 million people joining the labor force need. Now, if you sort of do the obvious inference from this, that you simply cannot create jobs on this scale. You have to create an economy where people like us pay taxes, and our taxes are used to give benefits and subsidies and basically universal basic income in another name. I think that realization has dawned on the political class that koi aur solution hai nahi other than to tax people like us and distribute it to poor people. They're trying to do it in a way which doesn't distort the economy. So I think increasingly you will see benefits or subsidies linked to gender, linked to going to school, linked to going to college, linked to getting your children educated. So they're trying to make it a good dole rather than a laziness wala dole, ki ghar mein baith ke aap kamao. And I think that attempt is also laudable. You're making it a conditional basic income, आपको बेसिक इनकम मिलेगा कंडीशनल ऑन ABC rather than saying आपको हम पैसा बरसा रहे हैं आपके ऊपर. But that's the way I think most economies in the world will have to go, giving money to the poor basis the high earnings of the more affluent people.
Right, thanks. So one question I have over here for you is, you know, when you mentioned about export-oriented sectors as well, you have Trump 2.0 which has come in. How do you think India has the potential to then integrate further into the global value chain? Because there is a potential tariff war which is already on. Initially, we were talking between US and China. Now, I don't think so. India probably might be spared, might not be spared, right? How do you stride over this kind of a situation now?
So look, I think there are 3 sectors where I think India will be spared, and those 3 sectors I think will turn out to be very big. We've discussed one of them already. I think mobile phones clearly will end up being a big sector. Apple is a politically powerful company. Apple is, I think, making $30 billion worth of phones in India. They still make $170 billion in China, and I think that $170 billion, a lot of that will end up coming to India. Beyond Apple, other lesser phone makers will also come to India. So mobile phones is a $400 billion industry. I think iska 100 billion India aana to banta hai.
Okay.
Right? So that's the first area. I doubt Trump is going to suddenly mess that up. This doesn't make any sense. Dusra hai dawai, API, active pharmaceutical ingredients. That's a $200 billion global industry. At the moment, we only make around 20 billion.
Correct.
It's improved courtesy last 3-4 years, China +1 initiatives by the Western pharma companies. But if Trump imposes tariffs on Chinese API, that will lead to a massive flight towards India. We've made a lot of money on Divi's lab over many years, and we are staying invested in Divi's lab in the hope that Trump does ramp on.
But do we have the capacity ready to supply that kind?
Much as we saw with iPhones, right? 5 years ago, there was nothing to do with iPhones in India. Apple decided strategically, they sent a team to India. I think between Foxconn or Bharat FIH and the Tatas, they worked together. The Tatas, I think, this morning I read they bought Pegatron as well. So in India, jab zarurat padti hai, things move fatafat, really fast, right? I reckon we could see a similar outcome on API, right? So it'll be very interesting to watch what Trump does on APIs. As a Divi's shareholder, obviously I'm optimistic that हमको पैसे बनाने का chance मिलेगा. We also invested in some suppliers to Divi's. So there's a company called Ami Organics we own, which is a supplier to Divi's. We also have alkylamines, which is a supplier to Divi's. So ये हो गया दूसरा theme. Mobile phones, active pharmaceutical ingredients. Third category is medical devices. Colossal industry, same size as mobile phones actually. $400 billion industry. There is a PLI scheme here, but I'm not so sure how effective it is. But natural area for India too. I think we only make $2-3 billion worth of this stuff.
Correct.
Right?
And now I think you have Siemens and the likes which are going very big in this segment.
So I think this is an area where which similar to mobile phones, यहाँ पे बड़ा बन सकता है. And we've invested in a company called Polymedicure in the hope that Polymedicure will supply more and more medical equipment made in NCR, made in Faridabad, into the Western world. Iske aage, beyond these 3, right, I struggle to figure out where is our competitive advantage in beyond this 3, right? So there's a lot of hope that jute mein hum kuch kar payenge. There's a big footwear park outside Chennai. But given the labor costs in India are much higher, 3x higher than Bangladesh, I would say higher than Vietnam as well. I'm not so sure how competitive we'll be globally in footwear. Similarly, apparel. Can we become a global exporter of apparel? I don't have a grip on, are we really competitive on land prices, labor costs, and cost of capital to be competitive in stuff which is not dimag wala kaam. Dimag wala kaam, our large workforce of graduates comes into play. Right? So knowledge intensive, light manufacturing. We are at in our element, and I think we'll end up between these 3 sectors alone. We'll end up creating $300 billion of GDP.
And that's going to be a good number on that front. But with that, you also mentioned a point about you looking at investing some portion in the US markets, European markets. I'm sure everyone over here wants to understand how should one invest in European and US markets from a operational perspective also, and is it, I mean, are there any further regulations to it? Because I think for a student who's looking at investing, right now the avenues are only Indian markets.
Right. So just to quickly figure out why should we invest abroad, right? Jaye kyun wahan jaye to. So at a very simple level, America has been the most lucrative market in the world over the last 1 year, 10 years, over 20 years. We are better than them, but over 10 years they're better than us. And these are the two big markets in the world. Dunia ka 2/3 paisa, 65% of world stock market wealth is created in these two massive free market democracies, right? Now, their market, the Western world in general, has three things our country's market doesn't have. Firstly, they have very high-tech manufacturing. So, for example, all of those phones that you're carrying, inside there's a semiconductor inside the chip. On that chip is lithography. Lithography is the etching of circuit design. So there'll be, say, 10 billion circuits etched on an iPhone 16 chip, right? So the iPhone 16s which are being made in Bangalore area, there are 10 billion circuits in that. There's one company and one company only in the world that can etch 10 billion circuits on a wafer the size of a grain of rice, right? It's called ASML. It's a $400 billion market cap company in Eindhoven in Holland. So the first reason to go and invest abroad is very high-tech manufacturing of the sort our country doesn't have. The second reason is technology as a utility, right? The basic technologies which drive our day-to-day life are owned by the Western world. So simple example being, say, Amazon or Microsoft, right? Microsoft alone will be as large as the Indian stock market, and for obvious reason, very few of us can live a day-to-day existence without using Microsoft in some shape or form. And the third reason for investing abroad is deep luxury stocks, ultra luxury stocks, which are primarily from France and Italy, right? So over the last 25 years, the number of dollar millionaires has gone up every year at 7%. And there's a colossal market now for very rich people to buy very expensive things, right? So for example, handbags costing $40,000-$50,000 are sought after by rich women the world over. Only one company makes those. It's called Hermes. It's listed in Paris, right? Now till 3 years ago, it was reasonably tricky for any Indian to invest abroad. Combination of technology and government liberalization, especially GIFT City, has made it much easier. So we set up our office in GIFT City 2.5 years ago and started investing abroad. We worked with a brokerage called Interactive Brokers. There are several brokers. Any of you can try to open a brokerage account in the Western world. Opening the brokerage account is reasonably straightforward. If you do it yourself, you end up paying slightly higher taxes, right? Long-term capital gains tax is now the same. The July 2024 budget, Nirmala ji harmonized the long-term capital gains tax regime. It's 12.5 both places. Short-term capital gains tax is much higher though. It'll be lower for you guys because you're students. The short-term capital gains tax is at maximum marginal rate. So if your maximum marginal rate is 0, I would say do foreign investing now rather than when you get to my stage in life where the maximum marginal rate is closer to 40%, right? So for youngsters, open a global brokerage account, right? Several of them, we use Interactive Brokers, but feel free to choose your vendor. And long-term capital gains tax is the same as India. Short-term for youngsters like you will be actually pretty low, right? Now, in our case, because our clients are slightly more grown-up people, we've gone and created a fund structure in GIFT City. And from our GIFT City fund, we invest into America, Europe, and Canada.
Right. I think we'll be running out of time on the show, but very quickly, let's just take a couple of questions from the audience. The first one.
So I'm Vyomkesh Bhatt. I'm from NMIMS Mumbai. So my question is, in an era of rapid automation and AI, how could the government incentivize industries to reskill their workforce instead of replacing them?
Yeah, I think massive, lovely question here. I think it's a huge task. I can't see how can the government do this. I think the education system in our country will have to be rewired, right? Our education system, and I'm part of it, all of us are, focuses a lot on rote learning. As I think you're already alluding to, AI makes rote learning useless, right? There's no great value in knowing the 16 times cut tables, because soon there'll be an AI chip in my spectacles that will give me 23 times cut tables and 49 times kabhi tables, right? So the rote learning wala education, which is what our education system specializes in, is gradually becoming useless courtesy AI. And I think from top to bottom, from kindergarten through to university, I think our education system needs to be revisited. Basically what we have, if you think about it very deeply, challenge is we have a socialist education system in a capitalist economy, right? So the socialist education system simply does not heed free market signals. It keeps churning out students with the same purane zamane ka skill set in an increasingly modern economy, right? Now, should the government be solving that or should the free market be solving that? As an entrepreneur, I would like to believe that your generation of bright young people will be the free market entrepreneurs who will solve this colossal problem and make a lot of money out of it, right? Because as I think is evident, right, lots of young people are graduating from college, but the reason they're not getting jobs is not because there are no jobs, but because there's a mismatch between their skill set and the job and the skill sets required by employers.
I'm Mihika. I'm an equity research analyst at NDTV itself. My question is more broad-based, in a market where everyone's talking it's overvalued. You just mentioned it may not be a very happy picture for Indian markets in the next few years. For someone who's just become eligible to invest or someone who's just entering the market, where do you find value? Because, while there are stocks out there that have made returns for other people, their time frame was longer. So how do I, put my strategy forward in a way that a better half of my portfolio is not in losses for the next few years?
Right. So I think the simplest way to think about that is think about sectors which have good companies, but sectors which have been out of fashion for several years, right? The whole area around non-urban India, low-income people, agri-related companies, right, has been out of fashion. And within that ecosystem, there are several good companies. We've invested in Escorts Kubota, but there are other agri-related plays which are high-quality companies. For your generation, for analysts like you, the data is widely available. The annual reports are all available. For journalists like you, you have access to the management teams as well. So there is a multitude of good companies in the agro and non-urban ecosystem. Similarly, whilst IT stocks have now run up considerably, in pharma ancillaries, the ecosystem which supplies ancillaries into pharma, there are several good companies who are waiting to be discovered. And finally, the least fashionable sector for many years was private sector banks, right? And as we discussed, some of the private sector banks are coming back into fashion because they're conservative, strong institutions. So the beauty of the stock market is at any point in time, there'll be things which are in fashion, revved up to high heaven, and there'll be things which everybody has given up on. And as we go through the next couple of years, there'll be some of the darlings of yesterday, say the PSU capex plays. A lot of people will give up on them, but they will take to new darlings. The new darlings will come from, I suspect, the strata of India's economy, which caters to non-urban, rural, and people earning below 5 lakhs.
So do you feel like themes like railways and renewables that had quite of a dream run in the last 2 years would see a slowdown? They've seen correction already. Do you see that will continue, or could we see an uptick?
So as I said, anything around government capex, right? I'm not so sure where the money will come from, right? Given that the government wants to consolidate fiscally, which I think is the right thing to do, if you want to consolidate fiscally, you don't have that much money. So where will you find the money to spend on railways? Renewables slightly different. Renewable private sector companies are doing spending. So if the private sector keeps at it and the government gives tax incentives to the private sector to do the renewable piece, it'll be. I think that will sustain. We need to see how, given that Trump has no interest in participating in these global climate accords, if he completely says ye sab bakwas hai and forget global climate accord and we keep getting hotter year after hotter year after hotter year, we'll have to see how our corporates deal with it. Because remember, the promoters in India who are investing in renewables, are doing so with a view to make money. They're not doing charity here. And if the world's richest economy says we have no interest in renewables, the business case gets a little tougher.
So there are going to be challenges coming in for that space, probably on global uncertainties as well. Thank you, Mika. In fact, thank you everyone for joining us as a part of the audience. Thank you, Saurabh, because this was absolutely an interesting conversation for the millennials, for the Gen Zs, I would say, which now we are moving to, I think, alpha and beta very soon. But an absolute interesting conversation with regards to what investors should be doing with regards to Budget 2025. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
I present the budget for a historic.
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about three key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme, where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at source, or TDS, as things stand right now. And the mutual fund industry is suggesting that this threshold be raised to 50,000 rupees, and they expect that this will benefit a lot of people because they won't then have to have tax deducted at source. Of course, there are more proposals that they've made, but we'll see what the finance minister takes up when she presents her budget for 2025.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Hi, thanks so much for tuning in. I'm Alex Matthew, and we're discussing Your Money Matters on NDTV Profit because we understand that your money matters. On this program, we talk about your investments, your expenses, and everything to do with your finances. On today's program, I've got a great conversation lined up for you about the National Pension Scheme. We speak about several options available to you in the retirement space.
well, investments in mutual funds, investments, of course, in the employee provident fund. But the NPS is not something that is focused on very often. There are various options available to you when it comes to investing in the NPS. I spoke with Mrin Agarwal of FinSafe about how you should go about your investments in the NPS. Let me start by asking about the relevance of this scheme. Of course, it's been an outstanding performance. We'll talk about that in just a bit. But people got into this scheme thinking of deductions more than the outcome or the redemption, which is at 60 years. And that is likely not going to be the case for many years or more. Of course, we're anticipating that the deductions will continue this year. But directionally, the government seems to be doing away with it. So what is the relevance of the NPS and how much of your allocation should be towards it?
So good evening, Alex, and thank you for having me on the show as always. I think NPS is still very, very relevant. One, because in the new tax regime, you still get a deduction. The salaried employees still get a deduction up to 14% in the new tax regime as well. Secondly, we are really undermining the amounts that we need for retirement. Now, let's say you have somebody who's 35, 40 years old with 1 lakh rupees of expenses. You actually would at least need a corpus of about 7 to 8 crores at retirement. And just the EPF or just by investing in a fixed return scheme is really not going to help you reaching there, right? So irrespective of whether the tax deduction benefits remain or not, the reality still remains that you do need a product where you can save for retirement, given and in it which allows you to invest into equity, which is low cost as well, and gives you a pension. Now, the biggest reason that NPS really works is because the funds are locked in and you're leaving your money over there to compound versus utilizing the funds for other needs or utilizing the funds for other investments because you feel that those investments are better. So I think there is still a need for the NPS simply because one really needs to save a good amount for retirement.
Okay. What kind of allocation would you give towards the NPS then? And really you're talking about a product that has multiple options, and we'll come to those options in a bit. I guess it would depend on that, right? Because ultimately you're talking about a mutual fund industry that provides you with a lot of options in the same asset classes that the NPS does.
Well, I think the percentage allocation is really dependent upon each person's retirement goal. So I would say it's a little difficult to kind of give a number and say, okay, I have 10% allocation to it. But I think when you're working on your retirement goal, and of course there are a lot of retirement calculators that are available online. Certainly, I would say that if you have the ability, allocate a higher amount towards the retirement goal in NPS versus any of the other instruments.
Of course, Mrin, the disadvantage of the NPS is that you have to wait till the age of 60 to get that redemption. And so for people who want to look at financial freedom by the age of 50 and want to draw on the funds that they've been saving for many years, this would be a drawback, wouldn't it?
Oh, yes. And that is one of the bigger disadvantages, because if you're looking at early retirement, you really don't have that much access to the funds. So, the first thing is that at the age of 60, only 40% of the amount has to be moved into a pension plan. And that number is even bigger if you are actually removing it, let's say, at the age of 50, right? So you're going to be moving almost 80% into a pension plan. So that inflexibility certainly is there with the scheme.
Okay. So let's assume that you do want to retire at 60, and so therefore it makes sense for you, or even if you don't, you want a certain amount of money available to you, 60% of which will be tax-free as a lump sum. The investment options available, there are quite a few. How do you make sense of it, Mrin?
All right. So you have the active option where you can decide how much you want to go into equity. Maximum is 75%. You can decide between government bonds and corporate bonds. Now, Alex, for a lot of people, it's actually very difficult to decide this. And most people just end up taking the default option, which is the auto moderate choice. So you do have the auto choice where the funds are invested in a predetermined asset mix based upon a person's age, and then they can choose the risk profile. So they have conservative, moderate, and aggressive based on that. When you actually look at the equity allocation, and the reason for looking at the equity allocation is this, that see, when you are investing into a scheme where there is a long term lock in, you would actually want to have a higher allocation to equity, because of the fact that you expect the equities to give you exponential returns in the long term, right? So when you actually look at the allocations between the aggressive, auto aggressive, and between the active equity, you would actually see that the percentage allocations come down drastically after the age of 40. And by the age of 50, you only have about 20% that's being allocated to equity versus in the active equity choice where you still have 75% going to equity. So I would say that if you have more than 10 years to go for retirement, certainly look at maximizing the equity component, and that can really be done through the active equity option. And hence, I would really suggest that if you can take the risk, consider the active equity option.
That makes sense. And how have these schemes performed, Mrin? Because ultimately, that is a big lacuna, according to me, in the NPS, where it's not easily accessible how these schemes have performed. There are 11 managers, right? How do you see which scheme to invest in based on performance?
Yeah, actually, that's one of the things that I keep saying, that it's very difficult to get rolling returns on NPS to actually make the right comparison. But you do have some SIP returns which are available publicly as well. And looking at the SIP returns again, when you see for example, the active corporate bond option has given SIP returns have been in the range of about 7.5%. But when you look at the active equity option, the tier one, of course, the scheme E, when you look at that, the 10-year SIP returns have been in the range of about 14 to 15%. So what I would like to say is that, of course, we've seen some good performance coming through, but I would still say that, please keep your returns expectations going forward to about 10 to 12%. That's one. And regarding the PFM, again, yes, there are 11 fund managers that are available. What I would suggest is that do look at the pedigree of the fund manager in managing pension monies. And of course, look at the consistency of past performance. I know it's a little difficult for individuals to really evaluate this given the limited data that's actually available publicly. So I would still say, just look at the 10-year SIP returns over a period of time to see the consistency of performance.
15% odd is what the SIP investment in the active equity component of the NPS has given you, which is quite good if you think about it, especially if you think about the tax-free returns that you get on a component of it, which is 60% of the corpus. Now, it so happens, Mrin, that there is going to be an option for systematic withdrawal as well, kind of like, I think, what you have with the mutual fund industry. If that option is available, should you take it?
Oh, absolutely. Alex, one of the most difficult things for people is actually to plan out how to get that regular return from their retirement corpus. It's not at all easy because, when you look at the fixed return options, they're in any case extremely limited, and most of them are taxable, right? Whether you look at fixed deposit or if you look at post office MIS or RBI floating rate bonds and whatever the senior citizen scheme, right? Now, the advantage with this SLW is that firstly, you don't have to figure out, like when you get this lump sum, you don't have to figure out how do I plan out this lump sum now to get regular returns out of it? Or even if you have to just invest it further, it's not something that you really need to think about, right? Because the money is already remaining invested. And you can set up this SLW. And, while it has not been clarified yet, but I still believe that the returns are going to be tax-free, because if the 60% lump sum is tax-free, if you're just utilizing the option to remove it as a systematic withdrawal, there shouldn't be I mean, ideally, even that should be tax-free, So you have these two big advantages where you don't have the headache to figure out what to do with the lump sum. The withdrawals are there on a regular monthly, quarterly basis, and they're also going to be tax-free. And the third thing is that the remaining money is just, are remaining invested and are growing. And remember, it's a corpus that's been there over a period of time, right? So that's the other advantage as well.
Now, when it comes to withdrawal, the other factor to take into account is the 40% which you have to put into an annuity scheme. And there are several options here. How do you choose the right one?
Okay, so there are various options that are available. The first one is annuity for life, where the subscriber gets it for life. And now there are two options always. One is with return of purchase price, and the other is without return of purchase price. So without return of purchase price means that there is no payout to the nominee. With return of purchase price means that there is a payout to the nominee. So you have like annuity for life, then you have annuity for life, then it's paid to the spouse as well. And the third one is where it is payable to self, spouse, parents, and then to the nominee, right? See, the difference between these plans is really going to be the payouts that are going to be there on the pension. So typically, the ones without return of purchase price have a higher pension. They're typically in the range of about 7 to 8%, whereas the ones with return of purchase price are between 6 to 7%. As such, I would recommend always take the one with the return of purchase price. I think the IRR that you're going to make there is going to be higher.
The internal rate of return, basically. All told, the option that Mrin has just given you is the best option available. Of course, there's more to talk about with regard to the NPS, some of which has to do with the extension of the NPS beyond the age of 60. But Mrin, I'll hold that for another day. Thank you so much for joining in and for giving me the perspective that you did today.
Thank you.
All right, now that's quite a bit about the National Pension Scheme, and hopefully you have a better idea of how to start that investment if you think it's appropriate for you. If you've got questions for us, of course, you can write to us on any one of our social media platforms and we'll take it up in a future episode. There is a piece of information that you should know about if you're investing in the mutual fund space, and that is that the SEBI is moving forward with its intention to start a micro SIP, or a chota SIP as it has been called. As things stand right now, the minimum required limit for a SIP or a SIP, systematic investment plan, is 500 rupees. This is mandated by the regulator. Now the regulator has sent out a consultation paper to the industry asking them to incorporate a 250 rupee systematic investment plan. What is this all about? In the consultation paper, the SEBI is saying that this is working towards sachetization of mutual fund investments and making it accessible to more people. But there are restrictions that have been proposed because the mutual fund industry has stated to the regulator in conversations that have happened over the past several months that there is a cost involved in facilitating these transactions, and reducing the size of the SIP is not very easy from their perspective. So what has been suggested is that an investor be permitted to initiate up to 3 small ticket SIPs, 1 per asset management company, while AMCs can continue to offer this 250 SIP beyond this limit. Intermediaries would only be able to allow discounted rates for the first 3 such investments per individual. So there is something of a middle ground that is being sought. The other aspect is that these 250 rupee SIPs are being proposed to be facilitated only in growth option of mutual funds. Of course, there are 2 options available, as you know, the income distribution option, IDCW, and there is the growth option. Growth is what most people prefer. Whether or not this is going to facilitate a boom in mutual fund investments is yet to be seen, but it seems like the regulator is quite keen on facilitating this 250 rupee transaction. Now, the other aspect that I have for you is Travel Thursday. And on this particular edition of Travel Thursday, I'd like to focus on locations that are in the vicinity of Mumbai and Pune. In fact, that is exactly what I asked my guest today to tell me about places that you can visit in Maharashtra. Ankit Bhatia, who is travel filmmaker and content creator, is joining me now. Ankit, thanks so much for joining in. And my ask to you, as somebody that lives in Mumbai, was to tell me a place or a few places that I can go in the vicinity of Mumbai that I can drive to maybe, that are very beautiful. And you said that there are so many places in Maharashtra that go overlooked. Tell me about these two places.
So basically in Lonavala, there are so many places, but I'll talk about these two places, which are one of my favorite. One is the Korighat Fort and the second one is Kataldhar Waterfall. These two places are not that popular, but it's very, very beautiful. So I've been there a couple of times and it's very easy to go. You just, drive for, I think 2 hours, 1 or 2 hours from either Pune or Mumbai side, and then you reach Lonavala, and then within 10-20 kilometers, these places, you can go for hikes, small hikes, and you can just cover it in one day and then come back.
Okay, let's talk about Korighat Fort first. And there are several forts in and around Maharashtra. Of course, those people that are familiar with the history of the region will know that the Marathas and Shivaji Maharaj was responsible for creating a lot of these forts. There's Raigad and there's various other regions also that have forts. But what can you tell us about this particular fort, Korighat?
So the one special thing about this place, which a lot of people will like, is that there's a there's a beautiful waterfall. That's Staircase Waterfall, and that's only been seen in the monsoon time. So like if you go really early in the morning, and you won't find any people, and you won't find this kind of waterfall anywhere in Maharashtra. So this Staircase Waterfall looks very, very beautiful, very pretty. And it's very easy hike. You would just take 45 minutes to reach to the top of the Korighat Fort. And you can enjoy the beautiful Ambi Valley views from there. That's what I like about it. When I started my journey, I used to go to these small places which are easily accessible, and then you can cover it in a day.
Okay. So can you do both of these locations? There's also Kataldhar
Waterfall.
So no, the right way to say it, Ankit, in Marathi is Kataldhar. I actually checked, and it's a little difficult for people who don't speak Marathi to say the but it's actually Kataldhar. But what is special about this one place, Kataldhar?
Again, it's very. First of all, I want to tell you that I really like waterfalls. So that's why I chose this location. This is still hidden. This is not that popular. Again, you go for a beautiful hike, and then you the beautiful thing is you go down the waterfall, and then once you reach like 2 hours of trek, and then you come back up. So it's the opposite. You're not hiking up. You're just going down, and then you come back. And there you saw this beautiful waterfall once you reach to that location, and there's one beautiful like hidden valley sort of thing that you see once you reach till the end. It's all about the valley views and the hiking with your friends. That's what I enjoy more.
If people have seen some of the content that you've created, Ankit, they'll know that you're more of an outdoorsy kind of guy, and you like to go to these places where you can do a trek and you can maybe even camp out. But a lot of people don't necessarily want that full experience. So if somebody is going from Mumbai and Pune to Lonavala, how would you suggest? So this is usually a weekend thing that you're suggesting, and this is actually a pretty cost-effective thing to do, right? Because you're just taking your car and you're going to a particular location and you're doing a trek. But where would you say that people should look for accommodation in Lonavala? Is it fairly easy? And how much should you set aside for that?
Okay, so the good thing is all these places are nearby Lonavala, and Lonavala is quite popular place for stays and for affordable options as well, because Lonavala is well developed. So you will find a lot of different kind of options. You can get good hotels as well, and you can get very cheaper hostel options as well. We stayed at one of the place where it was just 1,000 to 2,000 rupees per night. And it's very affordable. What I did is I went from Pune, and then I stayed overnight, and then I explored early in the morning. That's where you find very less people, very less crowd, and that's